Well, we'll call it's February 16th. It's 1 o'clock. This is a regular board meeting of the Board of Montana Board of Investments. We are videotaping the meeting, so behave accordingly. And can we have the roll call, please?
You bet. Carl England,
Here.
Jack Prothro,
Here.
Terry Cohe,
Here.
Bruce Nelson,
Here.
Diane Fladmo,
Here.
Maggie Peterson,
Here.
Mark Barry,
Here.
Jeff Meredith,
Here.
Representative Ken Walsh,
Here.
and Senator Ryan Lynch is absent. All right, we have 8 board members present. We have a quorum.
Thank you very much. Representative Walsh, nice to see you.
Good to be seen.
All right. We have some minutes of oh, whoops, there we go. Public comment. Any public comment of matters within the board's jurisdiction? Seeing none, we have minutes of the November 30th, December 1 regular board meeting. Let's do those first. Any additions or corrections? If not, is there a motion to approve? Okay, Mark's moved, Maggie's seconded. All in favor, say aye. Aye. Any opposed? Motion carries unanimously. And we have minutes of the December 17th special board meeting. Any additions or corrections? If not, is there a motion to approve?
So moved.
Diane's moved, Maggie seconded. Any discussion? If not, all in favor, say aye. Any opposed? None. Motion passes unanimously. Dan, do you want to introduce our new staff?
You bet. Mr. Chair, members of the committee, Ian Horwood, our new investment analyst. Very high pedigree. Worked for Cambridge, worked for DA. And prior to that, he was a University of Montana student and a long haul trucker. So I'll let Ian give you his bio.
And the Hershey Cattle Company, you can throw that on there too. Yeah, so great to meet everybody. Feel like you guys already know so much about me, but I guess I can go more professionally. I went to the University of Montana. I graduated in 2016 and immediately moved to Boston to work for a mutual fund company, worked on the sales desk there for about 1.5 years, started doing the CFA program and wanted to get into something more investments related. So I got started in the analyst program at Cambridge Associates. I worked in the private family practice. So we were managing endowment stock portfolios for ultra high net worth families. So anywhere between 200 million and a few billion in assets. So did that for almost 3 years. Analyst program kind of ends at that point. Kind of kick you out to business school. Was really interested for a while to get into wealth management. So I went to go work for a team at D.A. Davidson in the Seattle area, but just really missed the institutional component to investing, especially on the LP side. So I always, had my eyes fixed on Montana and moved back. I call it the Eye of Sauron, just less diabolical, I guess. Just always fixed on what was going on here. And so when I saw this job posting go up last year, I jumped on it. Yeah, really happy to be here. So.
Well, we're happy to have you.
Yeah, thank you.
And we look forward to hearing from you and spending more time with you when we get to spend more time with staff. But welcome.
Yeah, thank you very much.
All right. Anybody want to ask Ian any questions as long as he's here, or can we move on?
Benchmark, foreign exchange.
Benchmark, yeah. Do you want to tell us
Yeah,
about the
benchmark.
problem with our benchmark?
Yeah.
Private,
Oh, God, stop. That's an inside joke. You don't have to.
Yeah, I'm on the outside for that one.
Anyway, welcome Ian. Thank you.
Thank you very
And
much.
thanks for coming. Audit committee report.
This will be nice and brief. We met this morning. Julie went through the audit checklist with us and indicated that they'd taken off all the, as is our practice, to take off calendar year 2020 issues. So now it's 21 and 22 type things. She said that our annual report was posted to the website prior to the statutory deadline of December 31st. Said that they're going to be starting the SOC audit, do some of the initial field work anyhow in March or April. She discussed the ethics statements, indicated that all staff had signed theirs and all the board members today hopefully will sign ours. Talked about our financial audit reports. We had received an unmodified audit opinion with an audit date of December 7th. And the LAD allowed for early release of our audits in January 2020, so they could be used for our continuing disclosure requirements required to our intercap bond program. I think we all got copies in our packets. On December 14th, LAD and the staff, our staff participated in an audit debrief versus a formal exit conference based on the unmodified opinion. So good for them. Congratulations to staff. Dan did indicate that the only questions they had when they were talking about the Unified Investment Program was a question on the STIP reserve, and I believe net pension liability in the enterprise fund of $161. Sure he answered them just fine. So, Mr. Chair, that's,
Okay.
we had a litigation update and that was it.
Okay, anything, questions for Maggie? If not, loan committee, Jack?
Loan committee met earlier today. We didn't have any loans that we approved. We did have a extensive debrief on the way the intercap program is working. We've changed how we fund the thing from different types of bonds and new program. The main takeaway I had was we'll have substantial savings that we can pass on to the users of the program. And so I want to compliment everybody that we are looking at fees and costs at all times. This is one that really came through. Is there any questions?
Everyone was there and I think we were all impressed by how smoothly things have gone so far. Okay, anything else?
That's it for.
All right, HR committee, Terry?
HR committee was delighted to unanimously approve Dan Villa's recommendations to appoint Jason Brent as the Director of Public Markets and to elevate Kirsten to the exempt position staff. And we were all just delighted by both of those. So thank you.
Okay, and I think we need a motion
Yep.
on
Oh,
that,
sorry.
which I think we can do in one. can't we?
Yes. So moved.
Okay, so just so.
Yeah.
You have the illusion of
Kirsten, do you
power,
want your
Mr.
own
Chairman.
motion? Huh? Do you mind being lumped in with
That is
Jason's motion?
How is she gonna frame that on her wall?
Yeah.
Is there a second to that motion?
So the motion is to appoint Jason as the Director of Public Markets and Kirsten as an investment officer, correct? And that's made by the committee. Is there a second?
Maggie motioned and Bruce seconded.
And Bruce seconded. Is there any debate?
She's right there. Now's the time.
Now's the time. Huh? We don't want to do it in front of Ian or we could lose them both,
Yeah.
right? All right, any comments? Other than we're all delighted as to both of these and congratulations to both people. And it's wonderful that people who we've seen and have impressed us, get to. So thank you both for your service.
You need a vote.
We need a vote.
All in favor, say aye.
Aye.
Any opposed? I was coming to the vote. Comments from the PERS board member.
Yes, we met last week. I usually give you an update on our the audits. We had 23 audits, no, 31 audits performed, 8 had no findings, 23 had findings. Of course, there are the usual findings of people not being given the optional retirement membership if they're less than the 960 hours. We had a few unique ones this time. People being classified as eligible who were not eligible or who were eligible for TRS. So it was an interesting audit, but those 23 audits, there were none that were material. They were all pretty insignificant. So we also had a discussion and approved going out for an RFP for accounting expert for GASB issues, similar to what this board has. We extended the Sagitech support contract for another year. And we then had an IT report from an individual, I think his name was Jeff Patterson, regarding our product that we ended up with regard to record keeping, and it's called Eric or Harris. They're both out there. One's the employer recording something and the other one's, but anyhow, it was an interesting presentation. We spent millions and millions of dollars on this thing, and one of his first comments that he made to us is that the platform they're using is probably dated. Took a long time. So I guess he wouldn't really get off the fence as to whether or not we should start all over, but I think within the next couple of years, we'll probably be looking at another system. I don't know, the board will have to make that decision, but our board is very frustrated with the functionality of the system that we've implemented. So
Who was the consultant?
the consultant was Jeff Patterson with K-12 Montana. Let's see. We had a few other litigation updates. We have a issue with the Montana State Firemen's Association versus the state of Montana Public Employee Retirement Board with regard to the airport employees wanting to be part of the Firemen's Association, being in their retirement instead of PERS. And then you're all probably familiar with the Lewis and Clark County NACO issue that's still out there. So it was a
But
busy meeting.
there was a decision on that that was favorable to Impera though.
Oh, they just took off one of the issues. They didn't allow them to. But it's still hanging out there.
Well, the board has filed an amicus on behalf of Impera on that lawsuit, so that we're in it.
Okay, anything else? All right, thank you. Representative Walsh,
Yes, sir.
you've seen that I've lost control already, so do you want to give us any words of wisdom from the legislature?
Well, I'm not sure there's a lot of wisdom that comes from the legislature, but there's always drama that comes from the legislature. So, but no specific comments. So,
All right, thank you. Thank you. All right, moving on to tab 2, Executive Director reports.
No member requests from the prior meeting. We do have the monthly snapshot. You have the January 31 in front of you. Representative Walsh will email that to you today. You also have the State Street performance reports for the various pension systems that were distributed for January 31. I included a memo on disaster and recovery and emergency preparedness pursuant to the work plan, as well as listed our outreach efforts for the in-state and intercap programs, also pursuant to the work plan. Happy to answer any questions.
Do we need to take any action on the disaster recovery and emergency preparedness?
No.
Any questions? Yes, Mark.
So this list of outreach, this is from last year?
Yes.
All right. On the disaster recovery, on item 2 on State Street. Anyway, it said you're looking at overdraft protections and the event State Street is down for an extended period. Is there an assumption on extended period?
Longer than really 24, 48 hours. We need There's only a couple of nightmare scenario, well, I'm not gonna say only, there's a couple of nightmare scenarios of pension payments going out, insufficient cash to cover, needing to move quickly. State paydays are something the employees are constantly worried about, making sure there's enough cash for those. And then we have those couple times a year, large OPI payments, several hundred million that go out. Just making sure that we're in the event several fails happen, we've now got a fail safe on the depository side.
Okay, so number 4 there about microwave wireless internet. So if you're connecting there, is there a cost to the board to attach onto that or what?
No, we built it into the lease, so that's available to us as part of the lease for them renting the space on the roof.
Okay, so that's on this roof.
Yes, that's on this roof.
Okay, okay.
Okay.
And
When you
battery
say
back-
colonial roof, you mean this and not the,
The Colonial building roof, yes.
yeah.
And then the battery backup, where would that be located if you were to do a battery backup?
Just for this suite, it would not be a building wide.
So it's a small battery backup.
It would be several hours, not several days. We need the capacity to do, I mean, this is contemplating internet's down in the valley, power's out. We have to have the ability to do cash
Switch
movement.
So at least we know that's the only issue we should have.
Hey, Tammy, could you mute? Thank you. So we would have a battery backup. Right now, we have the little ones on the desks that accommodate basically shutting down. Nothing really more than that. So if we needed to do cash movement for, wrap up that day's work, make sure that we were able to accommodate the wires, fixed income, public markets, those that need to trade, as well as accounting and ops would have the capacity to do that.
So you're scoping it up, how many connections you need to have and how long it's gotta go. Okay, because the other thing about batteries is you're gonna have to regularly check them. And they gotta get replaced every once in a while. So there's some hangups with batteries.
It's a longer, tying into the conversation about this floor, it ties into that timeline.
Okay.
You want to be on the battery subcommittee?
Sounds like he is the battery.
I don't know, I've been watching those commercials. I guess you can just pull up a Ford truck and just plug it in.
There we go.
Yeah.
So you're gonna buy the chair a new Ford truck. Is that the motion, Mark?
So, Mr. Bella, in that last paragraph, can you explain what you mean by on the trans? You say after examination of both legislative and executive forward-looking revenue projections. I don't understand that.
So if there was an instance where we would be asked to issue tax receipt anticipation notes, the executive would be the one to ask. They would present us with executive level revenue estimates. But if we're going to be issuing debt, which isn't really debt because it's short term and it doesn't cross that June 30 calendar, we wouldn't just look at what is the executive who's asking for the money saying. We would look at, okay, what's the legislative branch revenue estimate say as well? Our, again, nightmare scenario, we get presented with a revenue estimate that doesn't necessarily mesh with what the revenue will be to repay that debt. And that would be a problem. So we'd want to make sure that we were looking at both revenue estimates to make sure that that debt, that those trans could be paid off by the end of the fiscal year.
Before they turn into debt.
Correct.
Question, when's the last time that we used trans notes in Montana? I don't remember the terminology. Except
03?
back,
No, you know what it was? It was 92.
and then
It
I
was
remember
Governor
1980s.
Stevens.
Yeah, because
Governor-
fiscal analyst.
us when that happened.
Governor Stevens got in a fight with Secretary of State Cooney and Attorney General. Because
Really?
the
Roscoe
board.
would have been.
Really?
Either way, there were two Democrats and the governor was Republican. And the two Democrats weren't going to issue the trans because the Board of Examiners is the Secretary of State, the Attorney General, and the governor. So it was early 90s. So it would have been Cooney and somewhat, it would have been Governor Roscoe then with Secretary of State Cooney, and that would have been Attorney General Zurich.
Missouri?
That would have been it. So that would have been the last time.
Yeah, they
How do I
couldn't-
know these things?
They couldn't make payroll, I remember.
Right.
Yeah,
Because it's been a long time
Remember-
since I remember that.
and who was the budget director who became a funeral guy?
But it's,
Was it York?
No,
Dave Hunter was the one that taught me about trans notes when he was budget director.
used to do them all the
Because he
time.
hadn't used them in the
about-
80s.
That was the last time.
Okay, any additional questions?
That's an important thing, because if the state does get in a cash crunch, we better be able to move quickly on that, because you can end up in a tough position for the state credit rating and everything else if you can't pay the bills.
Well, that and I don't want to be negotiating a rate at that time.
At that time.
Yes, here's our rate, here's what we can do, here's how we can help,
Here's
but
how the-
it's not
here's the
a,
process.
I need $50 million and I'm not paying any interest. Well, now we're in breach of fiduciary duty to the trust fund participants, so.
Okay. Anything else? All right, tab 3. New investment policy statements. Person?
Great. At the end of last year, the University of Montana was fortunate enough to get two cash inflows for specific reasons. First, the Lubric Experimental Forest. They sold carbon offsets to energy companies, and that was a pretty big dollar amount, and they got that just by doing what they're doing anyways. So, kind of a nice surprise for them. They want to put that in an endowment-like fund to provide ongoing maintenance to the forest, instead of having it sit and stip and be eroded by inflation. The second one, the Chief Earl Oldperson of the Blackfeet Nation passed away at the end of last year. So the university received a gift specifically to fund the Kiao Powwow, which is an annual event at the university. It's grown to about 5,000 attendees every year. Now 5,000 people go every year, I should say. And the university wants the same type of endowment-like fund to fund that. Are there any questions on either of
What kind of dollars are you talking about? What kind of dollars are you talking about?
So for the carbon offset credits, they are thinking about 3.8 million will be in that account. And then 300,000 for the powwow.
Okay. Questions? We need to approve these, so, correct? So is there a motion to, we probably should do these separately. Is there a motion to approve the policy for the Lubric Forest?
So moved.
Is there a second? Terry seconded. Any comments? Any further discussion? If not, all in favor, say aye.
Aye.
Any opposed? Motion passes unanimously. Is there a motion to approve the investment statement or investment policy for the Kiao Powwow?
So moved.
Second.
Okay, Diane moved, Terry seconded. Any further discussion? If not, all in favor, say aye. Any opposed? Motion passes unanimously. See how easy we are? Kristen?
Wonderful, let's keep it that way.
You want a promotion next board meeting? Let's see, we've got some, tab 4, new commitments for private investment in real estate. Who's doing that?
Online.
Hi, everyone. Can you hear me okay?
We can hear you.
Okay. Preventing BRV Lotus Fund 3. This fund and strategy focuses on growth equity investments in North Asia, primarily Korea and Japan, but does also have the ability to do investments across greater Asia. We recommended and approved this investment for $50 million last year. It's a relationship we've known for some time. I've known the GP for close to a decade. He has a very interesting background. His family is very connected in Korean business and society. He comes from essentially a chaebol family, which is these families that control a very concentrated group of conglomerates in Korea. But Kwon, the GP, is actually educated from Western education. He went to school at Stanford and was a venture capitalist in the Bay Area for multiple years before coming back to Korea to focus on this strategy. And I will pause there for any questions.
Michael?
Yeah.
I just wanted to go through the funding. So the preferred return, 8%, and that's what they have to hit before they get to do the, let's see, hold on. Before they get the carried interest, but is the management fee, is that taken out before or after that 8%?
The management fee is separate, and so you're correct. The preferred really ties to the management fee, ties to the carried interest of 20%, not the management fee.
So, hold on, so help me through that again. So there has to be a return of 10.25 before they get the carried interest, or they get the carried interest at 8 and we still pay the 2.25?
The 2.25 is paid regardless.
Okay.
And so the carry is on top of the 8% as far as the incentive waterfall and that flow goes.
So Michael, correct me if I'm wrong, but the carry, when we're looking at any of these, we would have to have all of our, we would have to make 8% on our money, right?
Correct.
In sum total, inclusive of.
Before they start taking a carry.
They would start getting carried.
So inclusive of management fee. So
Right, so right, so they have to hit that 8% hurdle net, shall we say.
okay, that's what I was trying to get to. Great,
Before
thank you.
they would start getting carried.
Thank you.
Is that correct, Michael? Accurate in this case?
Generally, yes.
I mean, it gets complicated in the documents, but.
Okay, thank you.
So, Michael, it's Carl. I don't understand what this means. Growth investments in a long-term strategic alliance opportunities targeting core growth assets of industry leaders with plans for strategic restructuring and growth. I don't know what that means. Can you
Fair
give me an
enough.
example or, something that?
I can. So
Okay.
broadly, the strategy of growth equity is minority investments. And so you're not buying and owning the entire company. And so you're making an investment where you have a minority stake. And so as pertains to your specific question, I'll give you an example. One of their first deals, they're working with SSG, which is one of the largest retailers and grocery stores in Korea. And so in working with them, really as an advisor, they partnered with them to broaden their online and mobile grocery presence. And so they are focusing with a really industry leader in retail and groceries and focusing on a different category and, you know, kind of a growth initiative as part of this larger conglomerate. And so that's the strategic growth off of kind of this core business that they have. Does that help?
So is that, so they form another entity or is that part of the?
They do. They
FST?
form a separate entity.
Okay. I get it.
So does-
And so- Go ahead.
And the general, or the managing director has an in here because he's well connected or well placed. Is that a way to put it?
That's correct. You know, he comes from a family that has been ingrained in the business environment in Korea. And so, you know, him and his peers all went to school together, grew up together, and they are the generation that is running, you know, the largest corporations in Korea. You know, Kwan doesn't like to talk about it, but, you know, his wife is the granddaughter of the LG family, which is one of the, I believe, top 3 largest business conglomerates in Korea. And so that's kind of his family ties as well as, you know, his peer sets. And so I think a lot of them are looking for advisors and ways to think about, you know, how to grow their businesses in this modern age from these kind of historically large conglomerates that have focused on more traditional industries and making that pivot to more modern or new industries and emerging technologies.
Thank you. Jack, I interrupted you.
No, basically you answered that, but my question on the strategy was really, it seems pretty broad. I mean, is there any real restrictions?
Gotta have growth.
No, it's a very broad strategy, and they have ability to invest in different strategies, geographies, industries, and we give them the ability to do that, to choose the best opportunities. You know, I think his background is a really interesting background where he has ties to traditional industries. But, you know, he was a VC in the Bay Area for, you know, over a decade and worked on, you know, some really interesting deals like PayPal and Waze. And so he kind of has this unique expertise and relationship set. And so this strategy is quite broad in their ability to make investments across Asia and across industries.
Thank you.
Okay, any other questions on Bruce, BRV?
Yeah, just following up on Carl's question about the A part under strategy. The B part with investments targeting category winners of high growth industries with a clear path to IPO within 2 to 3 years. What, I mean, is it normally public knowledge that companies are headed toward, you know, public offering, or is this something where we would be the beneficiaries, or this firm would be the beneficiaries of inside knowledge of that, or how do they know that, and how do we benefit from it?
Yeah, I think that varies quite a bit. As far as public knowledge, I think sometimes it's more obvious where a company might be raising late stage venture capital funding and they have a $5 billion or $10 billion valuation and they've hired bankers, and you can kind of sense that they are IPOing quite soon and in that process. And then other times it's not known to the public where the company is at. It's not a well-known IPO like I don't know, an Uber or something like that. And it's a little bit earlier. And that's where, you know, someone like a BRB acts more like an advisor to this company and kind of help them through that process, because that's something they've done numerous times. And so they provide, you know, the connections to raise capital, strategic initiatives, how to position the company best for a public exit. And so it can vary within kind of that strategy of, you know, part B of companies that are going to IPO.
Okay, thank you.
Anything else? All right, Michael, I think we turn now to Riverglade Capital, right?
Yep. Is Thomas in the room or online? This is his last deal, and so would give him the opportunity to present if he is available. Otherwise, I can run through it real quick.
I'm online, not in the room. More than happy to walk over real quick.
Okay,
You're
Thomas?
good. Keep rolling, Thomas.
All right, kick it off. Riverglade Fund 2, as you can see on the board brief, another re-up opportunity to continue the theme from last year, where we are already committed to Fund 1 with $25 million a few years back. We subscribed with $50 million here to Fund 2, in line with our pacing expectations. Riverglade, traditional small buyout control investor in a very large and very strong growth sector, healthcare, as you can imagine. Certainly had seen some tailwinds more recently in the last couple of years. But yeah, a very small, young firm. However, the team dates back over a decade at another general partner where we also had a relationship with. And the folks have been investing in this particular healthcare sector for over 20 years. That's where we got very, very comfortable with them and continue to the relationship here. We have an LPAC seat, just wanted to throw that out there. Other than that, terms relatively close to market. Nothing else standing out, and I'll just open it up for any questions that you might have.
Yes.
Thomas, I was surprised you just said a small staff and kind of explained it, but I was struck by how small a staff it is. I mean, 7 people running lots of money.
Yeah, it is a very small team. However, as I may have mentioned in the beginning, it is a sector specific, a sector focused team. So all they do is within the healthcare sector. You know, some examples might come to mind: a kids orthodontics, dental clinic, or substance abuse, mental health clinic. You know, those type of investments. So that's what they've been doing for over 20 years. And they simply spun out of a previous general partner relationship, formed this new team with a few extra folks. They are growing. They are currently in the process of hiring more staff, but we got very, very comfortable with during the on-site due to the sector focus and the relatively concentrated portfolio. As you can see here, we're expecting somewhere around 7 to 10 investments in this second fund. They have, I believe, 8 investments in the previous fund. So we are comfortable that they can handle that workload, and will continue to do so very successfully.
Thank you.
Okay, anything else from Mike?
I have a question.
Yes.
Is PwC doing the audits?
Yes, PricewaterhouseCoopers.
Yeah. Yeah, that's,
We'll spell it out next time. Apologize.
or at least just tell us what it stands for, make sure we're on the same page. Thanks, Thomas.
Yeah, one of the big audit firms. So
Okay, anything else? Thomas?
all good.
Thank you.
Thank you very much.
All right. Ethan? ITE Rail Fund?
Thank you, Mr. Chairman, members of the board. Presenting ITE Rail Fund. It's our most recent real assets commitment. Pretty straightforward fund. This is a group that owns and leases rail cars across North America. They own about 60,000 rail cars in total. They have exposure to over 300 different types of commodities, 700 different leases. 600 different lessees, 75% of which are, rated investment grade. We've got 20-ish types of different rail cars, and it's essentially a long-term cash flow play based on moving goods across the US that are essential to manufacturing inputs, et cetera. Team's been in business since 2014. They're 100% employee owned, done about a 12% net return since inception. Great sort of core real assets, infrastructure holding for our portfolio. It's open-ended, so it's a perpetual life vehicle. My intention is certainly to hold this position for likely perpetuity. We operate in a framework that theoretically exists in perpetuity, so I think this is a great long-term sort of asset liability match. Real-time cash flow distribution. Very good manager. They were great throughout the entire process, very transparent. John and I met with them in New York. Massive data analytics team where they're tracking commodity prices, credit ratings of the tenants, where their carts are, if they're on lease, if they're being cleaned, maintained, et cetera. One interesting aspect of this fund is they actually have their own maintenance and repair portfolio company that's owned by the fund, so they can sort of control costs and time to get carts on and off the tracks if they need to be painted or cleaned or something needs to be fixed. So they control that part of their value chain. Sort of a vertically integrated approach, which you may recall that we very much have a bias for, or at least I do, in real estate. So I think those are all the sort of the high level points I'd like to bring to your attention. Happy to answer any questions.
Yeah. Not so much on this particular investment, but there's a lot of different types of things can be in that asset category.
Sure.
What drew your attention to this particular field or industry?
Yeah, sure. Great question, Jack. So when I think about portfolio construction, one of the very first things that I think about is differentiation. There are thousands of people that come at me throughout the course of the year that are essentially doing the exact same thing, but just say it in a different way. And that's uninspiring and doesn't help from a diversification perspective, risk exposure perspective. And so rail cars are very differentiated relative to certainly what we have in the portfolio. So that caught my attention immediately. As near as I can tell, this is the only manager that has a platform that's been able to build scale and attract institutional capital and present an investment product to the market.
To the market of rail cars? Or
to the market of institutional investors. Most of this stuff that has scale, call it, 30,000 rail cars or more, are either publicly traded or they're owned by, Warren Buffett and his crew, et cetera. You just can't get access to this stuff and scale at an institutional level. And so that presented another interesting opportunity. The other aspect is it's very long-term. It's an open-ended fund. There's associated cash flows that are measurable and contracted through, 5 to 12-year lease agreements. So you can see the cash flows into the future and you can sort of project them. And it's sort of an essential service, if you will. I mean, if the rails shut down, we've got big problems in the world. So they continue to run throughout the pandemic. In fact, they actually outperformed. They carry essential products and that, for all sorts of things to grow our food, to build our cars. I mean, you name it. There's very diversified exposure across a multitude of industries. And so, if one industry is ebbing and the other one's flowing, you sort of balance it out through time. So very diversified, sort of steady Eddie exposure. Investment grade credit, even a lot of the non-rated users or lessees, or I'll get the name wrong, but it was like the Alberta Wheat Corporation. This is a family-owned and operated business that's been operating for 90+ years, privately held. They're just not rated, but very quality credit, for example. So maybe I'll stop there, Jack. Those are certainly some of the very high-level points that attracted me.
It's an open-ended fund, so if we want to get out, how do we get out?
So we're locked in for 2 years, during which our capital will be drawn down, and then it's annual redemptions. That's the word I was looking for. Annual redemptions. We give them a 90-day notice, and they can redeem us out at the end of each year.
So is it mark to market, or how do you know what the value is?
Yeah, they value it every year. They'll go through a valuation process. They'll value sort of the cars and the value of the cash flows, et cetera. Yes, ma'am.
So there's no secondary market on it.
It's kind of like core real estate in that sense, like, you can get out if you can get out.
That's what I was kind of.
Very comforting.
Yeah.
To your point about secondary market, I guess I would say there is a secondary market. There are lots of little. It's a very fragmented industry. There are a number of very scale businesses, but there's a number of folks that own 50 or 100 or 1,000 or 1,500 or 500 that sort of buy and sell. And they source from these people, as well as some of the bigger, they have partnerships with some of the bigger publicly traded companies. So, if they needed to upgrade their fleet, for example, they could certainly sell to somebody looking to buy. There's definitely a market for these cars. The useful life of an average rail car is 50 years. So they're very durable. And the lease rates that they charge, age factors in. Certainly the commodity type, the rail car type, those all factor into the rates that they charge, anywhere from say $350 to like $1,100 or $1,200 a month. So there is a secondary market for buying and selling. And there is also a scrap market for ending the useful life and selling the steel.
Marcus.
I think there's a secondary market too for, like, if we really want it out, we could go to another institutional investor.
I didn't want us selling scrap.
We could go to another institutional investor, I think, who knows, but
Absolutely.
and sell or something.
But at the end of each year, we could choose to get out at whatever the annual redemption cost is. But you're saying if
I'm
somebody
saying,
wants to
I guess
buy.
I'm saying, right, I'm saying subject to them being able to sell some rail cars to get us out, subject to, or some other entity wanting in at the same time. I mean, all of the same types of things we would see in a core real estate fund would apply. So, we could get out. I don't know that we could get out like, oh, today we want to be out and you're going to just write us a check. It might be, well, okay, we're going to work on it.
So that
It's going
is.
to take a little bit of time.
That's not unusual for this class of asset, but basically what you're saying. So within the core real estate, we have the same issue that it's not a liquid market.
Yeah, not a liquid market in the same way that,
That's right.
public equities are, or
That's
something
right.
where you can just go sell on the market today.
To answer your question very technically, to the extent we wanted to get out and there wasn't, for example, cash on hand, or they weren't in a capital raising period to immediately liquidate us, they will take a representative portion of the portfolio and they'll put it in a liquidating trust and they'll work through it through time. But like any other private market asset, yes, it's liquid. It's just to what degree and what are the circumstances around it.
Mark?
Okay, so you said that you're locked in for 2 years and then, but every year after that, they're gonna value our investment. Like, you got new cars coming in, you got old cars going out. So, but they can value that investment for us. It's a market that's able to do that.
Absolutely. There are also, it's just like the commercial real estate market. There are, and I could get you the names. Trying to think if I can recall one. My photographic memory has failed me in this regard, but anyway, there are a number of third-party actual valuation firms that are recognized and utilized throughout the industry for valuing. Yep, absolutely.
Okay, and then it says here that the fund may invest up to 15% of its portfolio in non-rail car related assets.
Sure.
What was that?
So think containers or barges, for example. They've entered into a number of transactions, a handful throughout the years where they've been essentially forced in order to get a transaction done to acquire they have a very small number of barges currently and a very small number of containers, but similar hard assets that you put on lease that carry things around that you can derive value from pretty easily.
And again, easily.
Absolutely. I mean, I've looked at container funds, I've looked at barge funds. The market is there. It's very similar to this fund from a structural perspective, liquidity perspective, similar players. Yes.
Jeff, did you have something?
Yeah, so like you said, there's several companies that operate in this industry that are publicly traded.
Yeah.
So what's the benefit of investing privately with this company versus investing publicly with, those types of companies?
That's a good question. I would say, I think, at least from my perspective and what I've seen in the publicly traded markets, they're more volatile relative to this. And there's been a little bit more yield compression in the space. So valuations are quite a bit more compressed and your current yields are down as a result of that. That said, there's certainly more liquidity in that space, without a doubt. There's trade-offs. And probably more active management, I would say. People sort of more actively focused on the management of the assets. Probably a bit more relationship focused on their current partnerships, their lenders. A lot of these companies that have big portfolios, it's not necessarily their core business. So they've got a lot of other things going on. So there's arguably a lack of focus relative to someone that's just living and breathing this day in and day out and properly, I guess I would say, aligned with their own capital, over 40 million bucks, and they're sort of shepherding that and wanting that to grow. So there's that alignment there and that focus, if you will, and attention relative to a publicly traded company that's maybe not just squarely focused on that. But it's a great question, and I think we look at those trade-offs now and again, depending on the asset, for sure.
So obviously you feel like this investment is going to, in your opinion, likely produce a better risk-adjusted return than investing in a public equity.
I believe that.
Counterpart.
Yeah, absolutely. I sure do.
I think to Ethan's point, in most instances, you probably have a more direct connection to the cash flow that you're going to get from this investment than you would say. I think Wells Fargo is one of the big
They own
players,
a
right?
big
So as an
portfolio.
example, like you could go own Wells Fargo stock. But obviously you've got all the, primarily the banking portion of it in there, and you're just getting a dividend off of the stock versus this being like, no, we're going to get cash flows off of the lease payments that are coming through this. And I think that most of the time would be typical in the public space, more so. I can't think of.
Yeah, GATX and Trinity, yeah.
A couple of those.
Yeah, they, I know they, for example, have a big barge portfolio as well. So they're not just solely focused on rail cars, but good. Yeah. Thanks for the question. It's a good one and one we think about regularly, for sure.
Mark, so $100 million into this fund.
Yeah.
And but I look on here and you have about 700 million in the real assets class. So this is a big play for that asset class. That
it is.
Okay, and that's okay.
Yes.
You
know,
Expected to know.
I guess I would, maybe I'll defer to John, but I think these private investments are areas of the portfolio that we want to continue to grow incrementally through time. And it's not going to put us over our skis. We have a range for a reason. This will certainly keep us within the range. We're in no way, shape, or form in danger of broaching the range. But maybe a comment or two, John.
Yeah, I guess I'd say just a couple things. So $100 million in this space for this type of strategy, I consider this fairly, I'm gonna call it bond-like, it's that steady cash flow. Wouldn't be putting 100 million into a venture capital deal or something like that. I could even see this growing, right? Because to me, this is a manager, if we were talking about the public equity space, when I'm talking to Jason, we tend to talk about things in terms of, well, are we going to move the needle or not with an investment with a specific active manager? Well, 150 million is 1% of the overall pension portfolio. So this doesn't even rise to that level.
Right. Okay.
And so I, just kind of given the risk level here, the steady cash flows and the comfort, and Ethan left out the best part. We also visited their rail facility in Kansas City and saw how they fix all the rail cars and got to climb on the rail car and figure out.
You get to toot the horn?
Didn't get to do that. I had no idea there were so many different types of rail cars and some of the engineering that goes into getting the commodities in and out of them. It was pretty interesting.
They don't actually own the locomotives.
Oh, yeah. No, they don't.
The railroads do.
Yep. But yeah, okay, that answers your question.
So, yeah, I don't need a ton of detail, but so they own the cars and then lease them and maintain them, right?
That's correct.
So they.
And they lease them to the people who are shipping the commodities?
ExxonMobil, for example, is one of their biggest clients. I mean, if you think about, ABN AMRO, big commodity wheat producer, yes.
And then from that point on, it's up to the lessee and the railroad to get it from
where
point
it's
A to
going.
point B, or if it's sitting
Yep.
on the
We have no
siding
risk.
over here, they're
There's-
still getting their lease
We have no
payment.
risk in that regard.
Okay.
They're still paying us rent, whether it's in the wrong place, stuck on, turned over in a cow pasture somewhere, we're still collecting rent.
Yeah, during the Great Recession, just drive to Great Falls and, from about Wolf Creek on the old BN line, there were all the rail cars sitting there that BN was using because of the downturn in the economy. Those had been leased cars, like they say, they were still paying. Even if they weren't shipping wheat or coal or whatever.
Okay, but that goes, so risk of loss of any damage or anything like that, it's absorbed by who's ever leasing the cars?
So I guess I'll cobble together an example. I mean, if something happened to a rail car from a damage perspective, it's going to be the railroad's responsibility. Who owns the rails? Who owns the locomotive? It is not on ITE.
They're gonna recover from that.
They're simply less leasing the rail cars.
Because you get, again, back to the containers, hell.
They own the rail cars. They will have a claim with the railroad,
Yeah, okay.
not the credit tenant, if you will.
Those containers fall off those ships.
Sure they can, sure they can. That's right. Yeah.
Okay. It's real estate on wheels, isn't it?
Yes, absolutely.
So one final comment I might make here is, I love this deal. we've talked about it a lot. It's just a great fit for the portfolio overall in the real asset space. But that said, you know, one of the things coming up in May, we have kind of the policy statement scrub across the board. I think this type of deal within real assets would be a great fit, say in trust fund. So I've talked about it with John and Kirsten and things that within trust fund, I think specifically, and maybe even within state fund, who we have a meeting with in a week or two, you know, we may come to you in May and ask for real assets as a asset class category within those portfolios, which they are currently not. But given kind of the cash flowing nature of this, it's a good fit for somebody like that, I think.
Question though, so like the coal tax trust then, right?
Yeah.
But that cannot be in equities, correct?
It cannot be, I forget how it's phrased in there. but
Private corporate stock.
Right, you're right, but it's kind of like the real estate thing where I think this.
Yeah, I'm just
does
saying,
not-
but I think we need a legal
Fully aware
review of
of
it
this.
because twice that's been voted down by the Public Credit Initiative to be in equities.
Agreed.
Okay,
Sensitive to that.
thanks.
Okay, see y'all in a
Always
little bit.
interesting.
Thank you very much.
We've got on the agenda a break, but Doug's got a scheduling problem tomorrow and like Louise does too. So, and we've already heard pretty much all Louise has to say, and Doug's is short. So let's cover those right now. So if you turn to tab 9, Doug, right? That's
Yes,
you.
yes.
And give us a quick run through and
Sure. Good afternoon, Mr. Chairman, members of the board. Just a review of the commercial and residential loan portfolios. As of January 3rd, the commercial loan portfolio was a little over 191 million, representing 108 loans. I have 5 reservations that are a little over 17 million and 8 loans that are committed for roughly 6.5 million. The commercial loan portfolio, if we exclude the veterans home and multifamily cold trust and the intermediary relending program, has a yield of 2.63, and we have no loans over 30 days past due. Residential loan portfolio has a balance of a little under 2 million, and with 55 loans, and the yield is 6.26. No reservations. We have 2 loans with FHA guarantees that are over 90 days past due, roughly 6.15% of the portfolio. The Veterans Home Loan Program has a balance of a little under 48 million. It's 273 loans. The yield's at 1.66. There's 1 reservation for 278, 250, and the yield on that is 1.05. There's 4 loans over 90 days past due, or 1.17% of the portfolio. And they have a remaining available balance of a little under $2 million. And then under the multifamily cold trust program, the balance is a little over 5 million. That's 4 loans with a yield of 2.65. They've got 3 reservations totaling about 9.3 million with a projected yield of 2.53. None of the loans are past due, and they've got a little over 600,000 available left in that fund. And then the IRP program has a balance of a little over 4.8 million, which is 36 loans. The yield on that is 2%. There's a little under 500,000 available to advance. And we've got 2 committed loans at 750,000. No loans past due, and we've got our remaining available funds of a little under 4 million. Dan reviewed the down payment assistance program earlier, so I won't go into much detail there. So, any questions? Yes.
Doug, you know, they had a moratorium on foreclosures. Did you think that created any additional risk or slowed down the process if we have some loans in the VA program? Or FHA, does that Great, anything that we should be aware of?
Yeah, you're correct, Jack. They did or do still have a moratorium on foreclosures. But they've come up with some pretty unique programs to assist borrowers who are delinquent, where they can essentially borrow the amount that they need to bring the loan current, and have that tacked on to the end of the loan. So there's options for individuals who want to try to work things out. But if the loan goes into default, goes into foreclosure, we always have the guarantees from FHA or VA to pay off our loans. So the risk is very minimal, with a default or foreclosure.
Doug, and you just mentioned this, but the Veterans Home Loan Mortgage, those are VA backed or the residential loan portfolio?
The Veterans Home Loan Program, the majority of those do have VA guarantees on them. I think there's only a couple of them that have FHA guarantees in that portfolio.
But they're guaranteed as well.
They're guaranteed. And then within our residential portfolio, there's a mixture of FHA guarantee and conventional loans, which are loans that don't have a federal guarantee on them.
Okay, thanks.
Activity in the commercial.
I'm getting calls from lenders. We just did have a reservation here for a project in Circle. So still getting inquiries. Nice to see something coming from Eastern Montana. So there's still activity happening out there.
Is it picking up now, or has it been, I mean, because it,
Maybe a little bit from the past, I think during COVID, in 2020, definitely slowed down during that period, as far as getting inquiries from lenders. So it's picking up.
all right, anything else for Doug? Thank you.
Thank you.
Louise, you're back. Always a pleasure to see you. Yes, Ray.
Right.
What's it called?
This is tab 10, and I know that we had a really good discussion this morning, so I'm open for any questions that you may have on the activity summary or the staff approved loans. No questions, that's it.
How about a joke? No,
I don't
wanna
have
put
any.
you on-
I don't-
Nothing's coming.
I
I'm
don't want
sorry.
to put you on this
I'm
one,
sorry.
sorry.
Nothing's coming from. Looks like a lot of work's gonna be getting done with all this.
Yeah,
Yes, yep, a lot of equipment purchases. Was something with the commitments compared to last year. Commitments are up, but compared to last year, actually the last couple of years, our fundings are down comparatively for December. So with those new commitments that came in last year, we should start seeing those starting to roll in and fund projects in the summer. Because most of those are construction projects.
Anything?
That's it for me.
All right. Thank you.
Thank you.
Thank you.
Why don't we take a 15-minute break? Will RVK, will they be ready to go at 2:30? Does that work?
Yes,
Mark?
yes, sorry, just turning it on. Yeah, we can go a little early.
Does that work for you, Mark? At
Yep, that
2:30?
works.
Well,
Can you hear-
1:30 your time.
Yep.
All right, so we'll take a break till 2:30 here. Session, and the meeting is in progress. And we're behind tab 5. So is that, Mark, is that you?
That's us.
All Oh, my God, what have you got going now?
So it merits an explanation. So thank you, Mr. Chairman. Erin Basewood should be joining me shortly too. I think she may have some trouble logging in, but for those unfamiliar with her, Erin has been actually with this team for quite some time, and you're doing a lot of the project work in the background, but was recently promoted to consultant, so you're going to be seeing more of her. You know, in terms of the background here, I don't know if you remember a long time ago, probably about 6 months after the pandemic began, when you look back at the great influenza or the Spanish flu, most people think of it as kind of a 6 to 9 month event, but that's not how people at the time experienced the event itself. In fact, yeah, they really didn't declare victory until March, almost 100 years ago to the day, on March 3rd, 1922. So, you know, things are calming down. Case rates are going down a lot, but the way people look back at this event in 10, 20 years, it may seem like it was shorter than we actually experienced it. And that's kind of the purpose of this newspaper clipping, and it is panning out that way so far.
The newspaper clipping, it looks like you're living in.
Yes. Yeah. But you know, there's a lot of comparables, and we'll get into it as we go through the report. There's a lot of comparables going on right now to what we experienced 100 years ago. A lot of it's been forgotten, and it can actually be helpful to remember it in terms of setting expectations for the future. So just really quickly before, yeah, we repeat this every time, but we purposely designed an executive summary that is much shorter than the 100 or so page performance report. So you're limited on time. Time is always your scarcest asset. Feel free to review the executive summary. It should give you 80-90% of what you need to know for the meeting. Just some really quick comments on capital markets. The last year, as John Putnam will get into, was pretty exceptional for the Montana retirement plans. It's hard not to make money when there's so much fiscal and monetary stimulus in the system. Again, while we're not through the pandemic yet, it does look like things are getting toward at least the end phase of this. People are starting to spend a lot more. You're starting to see, well, not starting to see, you have seen inflation pick up as a result. And you know, that's kind of a big issue, and I'll get a little more into that. But you know, essentially what you saw last year was when you have a lot of money in the system, a lot of fiscal stimulus that during the acute phases of the pandemic was stored up in excess savings, as people, that needs to go somewhere when people start spending it. And it either goes into assets, and asset prices rose pretty substantially, as you'll see, or it can start going into spending. And you saw that really escalate over the past 9 months. You combine that with labor disruptions, the labor markets are very tight, inventory drawdowns, and just unpredictable demand patterns in sort of a post-pandemic environment. And that is the cause of inflation. And the same, you know, again, going back to history, this same pretty much the exact same thing pretty much happened in 1919 and 1920. After 2 years of it, the Fed raised rates aggressively and poked a hole in the inflation bubble. And you actually had the reverse within a year. You had short, but somewhat severe depression and actually deflation. So thus far, we don't know what the future holds. We definitely don't know when the turn is going to come, but this is playing out remarkably similarly to the events after the last pandemic and also World War I combined. So where the Fed is right now, I'm sure you've read the newspaper and have seen the increasingly strong statements coming out of the Fed that they're going to tighten pretty significantly this year. I think the consensus now is 4 to 5 increases before the end of the year. That it could be more than that. But they're starting to get very concerned about inflation, and there's good reason for that. What they're concerned about now, I we probably were waited a little too long, you could argue, but the initial assessment that inflation was likely to be, I think transitory was probably a poor choice of words, but temporary probably was not, is pretty well grounded. I mean, we have experienced this before, not only after World War I, but after World War II. But the danger now is if inflation at this level goes for too long, it starts getting embedded into people's expectations. And then that starts getting it woven into the fabric of the economy. So labor unions start, building in very high CPI increases into their contracts. Companies start factoring in price increases into their basic financial models. And once that happens, it's much more costly and difficult to break the back of inflation. And that's what you saw in the late 1960s. It escalated into the inflation of the 1970s. And we're at the point where the Fed needs to stop this before it gets embedded in the economy. So bottom line, the hawkish messaging you're seeing out of the Federal Reserve, I would recommend listening to it. They probably mean it. So that's where we are right now. In terms of what to do with the portfolio, as you know, you're a perpetuity. Ethan stated that well in his review of the railcar investment. And you don't worry about timing issues that are impossible to predict. It's conceivable that you're going to see a pickup in volatility as the Fed starts turning the screws on tighter monetary policy. It's conceivable that you're going to see significant declines in asset prices, but nobody knows when or how much. And trying to time that in the short term is a recipe for disappointment. There's a good quote that we use to open this executive summary, which is a good one to remember when you're tempted to start playing with market timing, which is from probably the best chairman of the Federal Reserve we've ever had, Paul Volcker, which is there's a prudent maxim of the economic forecaster's trade that is too often ignored. Pick a number or pick a date, but never both. And that's a useful thing to keep in mind whenever that ubiquitous temptation starts entering your brain to try to time the market. It's just, it doesn't usually end well. So when I pause there, any questions on the capital markets, or I'll get into, then we can get into how it affected the actual portfolio.
Questions from anyone? Forge ahead there, Mark.
Great. Well, if we go to page 6, you can see and I'm going to spend most of the time, if not all the time, in the executive summary. You can see on page 6, the table there is the total fund performance on a net of fees basis versus we're using the public employees fund as a proxy here. They pretty much all match, just slight differences because of cash flows in and out of the funds. And performance is very good. Again, you had a pretty exceptional year in 2021. You can see sort of in the middle of the table, the calendar year to date, which is essentially 2021, the 1 year, a little less than an 18% return net of fees, pretty substantially outperforming the public employees benchmark. Now, a lot of that came from private equity, which just had an absolutely exceptional year. But even over long-term periods, you're pretty much, outperforming the policy index or benchmark on a net of fees basis, and also your rankings versus other large pension plans as proxied by 3 billion or more is pretty exceptional. You've ranked in the top quartile over all periods and top decile over most periods or all periods beyond 3 years. So these are very good results for the plans. When I pause there, any questions at a high level?
Don't see any, Mark.
Great. Well, moving on to the next page, you can see the allocation of the CAP, which is the primary vehicle for investment for the pension plans. And you can see the relative allocation to different asset classes. As we talked about a lot in the past, you have a lot of equity, both private and public equities, domestic and international. And for a perpetuity, this is appropriate. This gives you the growth that you need over the long term to keep up with the assumed rate of return that you're shooting to hit. In terms of the individual asset classes, we just because of the publication timeline here, we don't have rankings for each of the asset classes, and that's kind of how you rank against other institutional pools. So there are some NAs there. You know, the big, and John has already mentioned this, but the big recent change was moving domestic equity to a completely passive position in terms of your investments. Now you still have some tilts that you can do in small and mid cap and large cap, but they're all passive vehicles. And this is good in two regards. First of all, this is a very difficult place to outperform. Second, it frees up resources and just mind share for the Board of Investments to focus on areas that really can add quite a bit of value, particularly in private investments. And you know, those are the types of investments that Ethan and Michael and Thomas covered. So, you know, expect going forward domestic equity essentially largely to track the index. It's not going to track exactly, but it's going to be pretty close to the index. International equity, you did have a little underperformance for the last year, but generally long term, that is more of an inefficient place in the market, given dramatic differences in how markets are run and just knowing different countries throughout the world. There's more chances to benefit from inefficiency. Long term, you have added value pretty consistently there. Core fixed income, I want to comment on the rankings here because they look really low. The thing to keep in mind here is this is really benchmark against other composites that include a lot more than, you've essentially separated out a lot of assets in non-core fixed income that are often incorporated that are higher returning. So, you know, I think there's an argument actually to get rid of these rankings. The more relevant thing here is, you know, are you keeping pace with the benchmark? And you are, and you'll see as you get into the non-fixed income portfolio, the returns are a lot higher, but that's carved out now. John, I don't know if you have anything to add to that.
The only thing I would add to the core fixed income piece in terms of rankings is recall that there was a period of time there where we had all the portfolios benchmarked against an intermediate benchmark, and that was what we were shooting at for 3 years or so there, and then we switched back to the longer term ag. That cost us over that period of time, and so relative to peers who probably didn't do that sort of thing, there was a big differential during that roughly, I don't know, 3-year period or so there that we were doing that. So some of that sort of 5-year, 7-year, and then carry forward time frame is driven by some of that as well. But I agree with Mark that the overall ranking here is not very apples to apples.
Yeah.
And why is that again?
Because they're within that index that they have there, there's a lot of people who are probably including high yield and other things in that space, which would clearly skew the numbers.
Measuring against something different than what we've got.
Exactly.
Right, I get that, but then shouldn't that show up in better rankings in the non-core?
Well, you know, that's when we get to the next one. That's a tricky one too, because this is one of those things again where you kind of want to look at the long term. You have a non-core allocation which has high yield in it, it has preferred securities in it, it has emerging market debt. There's no real good benchmark for that. So, you know, we have used a high yield benchmark just to give you a rough approximation. I think I mentioned this before. I almost feel like the better benchmark here is, are you generating value versus your core fixed income allocation, which you are by quite a bit. If you look at the 10-year, about 6.3% versus 3% for the core fixed income. So I know we repeat this all the time, but it's just kind of, it's an imperfect metric. I would argue there isn't even really any good peer group to benchmark against, but you know, it's helpful to just have something to track, and long term, you're pretty much, you know, slightly above median here. But essentially the intent, and John, you can add anything that I'm missing. The intent here is to, in a very low rate environment, without taking on exorbitant risk, to add some return from different types of fixed income exposures. And I mentioned the emerging market type preferred securities and high yield, and it is adding quite a bit of value relative to the core fixed income allocation. John, feel free to add anything I missed.
Chairman, I would just say that similar to core fixed income, our peers classify these asset classes in different ways. So it's just not apples to apples. They may, in some instances, our peers may only put high yield in here. In some instances, they may put, all kinds of aggressive credit related strategies that perhaps we aren't comfortable with. So it's just I don't know, it's not very apples to apples, similar to core fixed income. I think, and I mean, Mark, you correct me, you guys are the ones that look at the underlying data here. I wouldn't pay too much attention to the peer ranking. I think the against the indices or the benchmarks that we have, that's certainly a very fair, long-term comparison.
Yeah, I agree. Geared up to explain this, and you guys said no.
I'm sorry, go ahead.
That's enough.
Question?
I mean, correct me if I'm wrong, Mark, but every time we get to the benchmark conversation, I kind of am on the Ethan page. It's 7.65 and 7.5. In the aggregate, it's 7.65 and 7.5. And the rest of it is good to know directionally, but that's the measuring stick, except, third best of the peers for John's performance evaluation. You'll want to talk about next year. Other than that.
Only during certain time periods do I want to.
Yeah.
Yeah, I mean, this is not something you discuss in a meeting, but I almost feel like the rankings for, well, I mean, my initial, I feel like we should get rid of them for non-core and core fixed income, because all they can do to distract is distract at this point. But we can talk about that offline. Moving on, well, I pause it. What other questions do people have thus far, kind of getting the performance up to non-core fixed income?
Go ahead, Mark.
Great. Well, the next two kind of go together, real assets and real estate. So it's an exceptional year for real assets and real estate that benefited from two simultaneous trends. One was there's a lot of money out there, and that allowed prices to get bid up on real assets plus and real estate specifically. Plus, they're both pretty well regarded as inflation hedges. So as inflation picked up, that made them even more attractive. Real estate continues to be one of the better performing areas overall in the portfolio over the past 10 years, just shy of a 10% return. Now, without getting into details, it's not a perfect benchmark, but you have performed well above and for overall time periods versus your real estate benchmark. Private investments were exceptional last year. The total return net of fees, about 40%. Now, these do tend to lag equities, public equities in terms of returns, but they also benefited sort of at the same time, and definitely to a bigger effect from the extraordinary stimulus out there. And you've outperformed the index by quite a bit over a year. Still kind of underperforming a bit over the 10 years, but pretty much in line, a little shy of the public equities index. Now these, we would expect if you do have a downturn, there's a lagged effect here. So you could see continued outperformance if you have a pullback in public equity markets. When I pause there, any questions on private investments and real assets and real estate? I have to add in there, I'm kind of a history buff, and I love, I emailed Ethan already, but I actually really love the rail car idea. If there's one example of an industry that has a long history that matches a perpetuity, it would be the rail industry. They've been around since the early to mid 1800s. This entire country was probably owes quite a bit of its prosperity to its extensive rail network. It's a niche industry, which if it's kind of a boring industry, which is usually a good thing for investments. So I was excited to see that investment. We'll see how it pans out. Moving on to the trust funds investment pool that has benefited from having its benchmarked against fixed income index. You do have some real estate and high yield in there too. It's benefited from that. So it's provided a pretty strong return versus just if you have it only in fixed income. Cash, you will see that yield pick up a bit. You haven't earned much of anything there because yields have been so low, but you will start to see that pick up. I think the base case right now is that in March, the Fed's going to raise rates by 50 basis points, have 4 or 5 rate increases this year. So you will start to see that yield pick up almost guaranteed by a couple months from now. Finally, this short-term investment pool, same story in terms of not yielding much to anything over the past year, but you will see that start to pick up as well as interest rates increase. Overall, the portfolio is in a very good place. One thing that you have done well is you've taken on risk that you can afford to take on as an institution, given your liquidity and distribution needs. That has paid off. You will have periods where that reverses. It was hard for that to reverse last year, given the incredible amount of money in the system. But if history is a guide, when the Fed starts shrinking the money supply, that's a pretty significant headwind for asset values, and you could see a pullback. So, what we've been telling clients is just to mentally prepare for that, and not to panic. It's not the volatility that kills investors. It's knee-jerk reactions to that volatility that kills investors, and it's important to kind of mentally prepare yourself. If that happens, just be prepared for it. When I pause there, what questions do people have about the portfolio, general economic environment, anything?
Yeah, Bruce.
Yeah, Mark, I was wondering if you'd, and again, trying not to violate the Volcker rule of guessing on both timing and what's going to happen, but how, given that the Fed has said, that they're going to start raising interest rates, it's always been interesting and highly ironic to me that the way that on the monetary side you deal with inflation is by inflating the cost of capital, because that tends to deflate the prices of everything else. But there is something ironic in that. How do you see that playing out over the next 12 months, 18 months?
I mean, the timing, what seems to me, and this is getting into personal opinion a little, but there's a lot of complexity in the economy, but when it comes down to it, without getting into the mechanics of it, think of all the assets in the United States. I don't know what the exact number is, call it 140 trillion. And think of all the currency out there, all that, I don't know, 10 trillion. And when you have panics like March 2020, and everybody wants to sell their assets at the same time, and there's only a certain amount of money to buy it, what happens is everything starts shrinking. And then what the Fed does, I mean, interest rates is a little confusing. What the Fed really is doing is expanding the money supply. And they do that so that people have enough money to buy assets, and they buy assets directly to prop it back up. Now, if they go too far, then values start inflating, and they got to pull the money supply out to pull it back. And that's it. Without getting into the mechanics are very complex, but without getting into the mechanics of it, that's effectively what's happening. But it's hard to predict, how many interest rate increases they have to do in order to pull the money supply back to where it should be. It's very difficult to predict that. But if I had to bet, if what I think the Fed is seeing right now is if we don't get a hold of this quickly and high inflation expectations start getting baked into the economy, it's going to be really costly to reverse it. And the runway is getting shorter and shorter. And if I'm the Fed, you're better off right now erring on the side of being aggressive, because if you're not aggressive enough and it sets in, you don't have to worry about unemployment. I mean, job openings are at a record right now. And if it sets in, I mean, just as a benchmark, it took in 1920, the Fed, they were called rediscount rates back then, but the Fed raised rates by 200 basis points, and it stopped 20% inflation because they did it early. Now they did it clumsily and a little too aggressively, but they did it early. Now, when they let it go for 14 years and high inflation expectations were built into the economy in the early 1980s, Volcker had to go all the way to 20%. And the reason he had to go all the way to 20% because he had to convince everybody that he wouldn't stop until inflation went away. And that takes a lot more. So I don't know, I'm rambling a little, but if I'm the Fed, I'm thinking I'd rather raise 200 basis points and take some pain now than allow it to go as far as it did in the 1960s and 1970s. And it's going to cost a heck of a lot more to stop it. I don't know if that answers your question, Bridge.
Yeah. No, you speculated a little bit more than you might have wanted to, but that's okay. That's what I was trying to get you to do.
But don't try to time it. It really is impossible to predict. It's possible that asset values won't pull back. You never know.
So Mark, you see other clients and other things in the market. I'm just always curious what other people are doing that may be a little different from us. Are other clients and other funds like us doing any de-risking, or what do you see in the market, just in a big picture way that's happening?
There's things that you see that you don't want to see, and things that you see that you do want to see. To be honest with you.
Oh, that covers it all. Thank you.
Well, I mean, there's people doing things. That doesn't mean you would recommend doing it. That was a pretty safe statement. But the thing that I think it's I really applaud the move to passive in U.S. equity. It's an efficient marketplace. At the end of the day, you have scarce resources, whether you like it or not. You have scarce time in terms of mind share for the board, and you want to focus on areas where you have the best odds of success, and that is not U.S. equity, and you're focusing elsewhere. I think that's a good move. I think the danger that people often don't appreciate is the cost of complexity that doesn't add value, and that's something we see with institutional investors that you have moved in the opposite direction of, which is, if you think back of all of the managers that you had in U.S. equity, international equity, and you've pared that down, where people are expanding that's dangerous, because it spreads your attention thin, and may distract you from things that are more value added. I have seen some adding inflation hedging assets out of short-term fears that, not with my clients, but I know that's going on. I think that's knee-jerk, and I'd be very cautious about that. But if there's one message I try to drill in, if you're a perpetuity with long-term objectives, then those are not subject to change very much on an annual basis. So if you're doing a lot of things annually to change your allocation, it makes me question whether that's being tactical. I don't see that here. So Big picture, that's probably the biggest thing, and I don't see that here. Long-winded answer, does that answer some of it? Or
Yeah, thank you.
Okay. Okay, Mark, what else?
I think that's it for my prepared comments. The rest of the report goes into, a little commentary on where some of the underperformance, outperformance versus benchmarks came from in the portfolios. I don't think it's necessary to go through the whole report, but I can highlight pages if people would like to. But overall, I think it's a generally positive message, and we're only half an hour in, so I have time, but let me know if you want me to go in a little more into the report, or if you have any questions.
Mark, I always think that this board is good at always trying to continuously improve our processes, and our results show that, I think. But is there things the board could be looking at that would keep us on that line of continuous improvement, whether education or other topics like, I don't want to mention the word hedge funds, but look at hedge funds again, or, is there anything on our continuous improvement path that we should be doing that you'd recommend?
I think, you mentioned the education. I actually think that it's funny, Aaron and I just had a presentation, and we're happy to replicate it here on risk management it was actually for a large endowment. And it was funny because when we were putting together the presentation, volatility was like the last thing in the presentation. The bigger thing is strategic continuity, which is, at the end of the day, your biggest challenge as an institutional investor is that you're managing a perpetuity with temporary people. And every time, both staff and board members, and us for that matter. And whenever there's change, there's risk that things can go in a direction that don't match the long-term objectives. Now, there's also the opportunity to improve, which is great. But I think one thing that's been very valuable, that's often maybe not as appreciated as valuable as it is doing the orientation for new members of the board, doing proactive orientation for staff members. That's not to brainwash them, but it is to familiarize them with the history of the plan, the key investment principles that have guided decisions, so that if there is a desire for change, people know where they're coming from, and can agree on the decision factors that would warrant that change. So we always offer that up. I think maybe that would be a good thing for maybe a future meeting this year, is just going through that risk presentation again, because what was interesting when Aaron and I were preparing that was just how everyone focuses on volatility as the best proxy of risk, and it's actually, I don't want to call it a distraction because it does feed into some risk metrics, but it's not the most important risk that you face. Does that answer your question?
Sure. Isn't that what we've always looked at? Volatility as a measure of risk?
Well, it is one measure of risk, but when you think about what could really set this board on a course that could be potentially harmful, it's kind of changing the overarching strategy in a way that doesn't make sense for the objectives. That's kind of a thing that's independent of volatility. And even volatility itself, it's an important metric of risk. It's particularly important in terms of measuring what the worst case scenario is. So, a lot of times, and we include this when we go over asset allocation, the best metric of risk is not the kind of normal volatility of the portfolio. It's what is a worst case, what does a 1% worst case scenario look like, and how are you going to react? Because if you're going to, call it a 20% decline in the portfolio is going to prevent you from paying benefits, or, you know, psychologically, the board is just not able to deal with that risk. Like, that's a pretty significant thing to be aware of. That's a derivative of volatility. But standard deviation doesn't really tell you that much. The max drawdown, which I, you know, just mentioned, actually tells you quite a bit, and how, and prepares you to think about how you're going to react.
That's part of what we took into consideration in that memo I sent you of, okay, how much are we going to be getting just dividend income over the course of a given year? If that worst case happens, rather than having to sell off public equities or something else.
Yeah.
We've just got this cash rolling in that we can look at first, so.
Rail car money.
The rail car rent's coming in like crazy. But, no, that, it sort of ties in to the analysis Mark and his team did a few years ago on liquidity. You know, what do we sell first in order to meet benefit payments? What other income sources do we have, and what are those things we don't want to sell in those down markets?
Well, if we've got time, I guess my question is the back of the, has to do with the back of the big report, which is the manager details. Is there anything here that draws your attention or that you think we need to be concerned about?
No, and not offhand. You know, one thing that we recently did is we've looked at a couple managers with fees, and we're able to get some fee reductions, which is helped the plan. You know, we mentioned the move to passive in U.S. equity, which we agree with. You've had some your international equity has underperformed a bit, but some of that was a lot of that was the exposures rather than the actual managers in terms of their performance. You know, high yield looks like an area that high yield is an area where it's very hard to outperform. So
what, Mark? I understand.
High yield fixed income is an area that's very hard to outperform. It's a tricky allocation because you can't go. It doesn't make sense to go passive. It's actually, you know, more expensive, and it's just not an area you can really benefit from a passive investment. But it's also really hard to outperform versus others. So, you know, the name of the game there is to make sure you're managing fees correctly. And that's an area where we've made some progress in terms of managing fees. So, you know, you do see underperformance there, but it's most managers underperform there. Yeah, I mean, nothing really stands out. That's not to say we're not looking at it constantly. But, you know, that's a good thing that nothing is currently kind of a red alarm. And, you know, some of that is the fact that you have tightened the exposures that you have to managers you really believe in.
Well, Mark, everything's positive, but must be the old banker in me, but I always like to look what can go wrong or what's wrong. Talk about some negative stuff if there is any.
Well, you know, I think it's hard to, I don't like being overly positive, but I'm just looking at the numbers on page 6. I mean, you're a top decile fund over every trailing period of 3 years and beyond. I mean, that's not, you know, just mathematically, that's a pretty good place to be. So it's hard to criticize you at a high level. I mean, I think the main thing is to mentally brace yourself this year. I mean, you could have, I think 2022 and 2023 are going to be tough. You have a lot of equity in the portfolio, or could be tough. I'm not going to say that it's definitely going to decline, but you know, they may look a little different by the end of this year, particularly in the short term. So I think you need to mentally prepare for that. But it's hard to criticize a strategy that has outperformed over the past 10 years, 97% of your peers. Mathematically, it's hard to criticize you for that. I mean, I'm personally disappointed that you're not 1, but I don't feel like it's fair to say that. I think 3 is probably pretty good.
And that's what's going in your email.
But when you talk about these returns, I think you taught me that in the second sentence, you always got to talk about risk. So you can't talk about return without talking about risk. And so at least I'd like you to talk about risk. I think we achieved those returns. It shows on one of those charts where we are compared to peers, but we've achieved that without undue risk.
Yeah, and that, I'm sorry, I should have highlighted that page. Go to page 12 of the big report. Just looking at over a 10-year period. In the upper left, you can see the crosshairs. Now, this is not a huge population because, they're just, at the time that this was produced, these get populated over time. And, in the 3 billion plus, there were only 12 plans, but compared to the median, which is the crosshairs of the red lines, is kind of the median return for the amount of risk measured in terms of standard deviation of the plan. The best place to be is to the upper left, basically meaning you're taking less risk and getting more return, which is precisely where you are. The Sharpe ratio, which is also it's a rough measure of risk-adjusted returns. They're in the top decile there over 10 years. So that looks good as well. Sorry, I wish I could find more wrong, but.
Well, according to your prediction, you will shortly.
So Mark, on the page 12 of the big report and page 11 of the big report have the two scattergrams, right?
Yeah.
And we're in the upper left-hand corner of both of those. That's where we want to be. That's great, all that stuff.
Yeah.
It seems odd to me that the benchmark in the 5-year is in the lower right.
Yeah, so this is a factor of, this is where the private investments play a role. You're benchmarking a lot of public benchmarks, which have a lot more volatility. That doesn't reflect the volatility of the actual investment. So I wouldn't pay attention to the benchmark. The more important thing is how the actual fund compares.
Okay, all right.
Erin, I don't know if there's anything you would like to add.
Yeah, I think, just speaking to the risk question, I think that, there is an important caveat here that this is point in time specific. So, it looks good now, but if we have, some rougher markets, it might look a little bit different. And I think another thing to consider now that we have gone passive in US equity, which I think is the right move, just given the efficiency of the space. But one thing to consider is that if we do have a drawdown in US equity, within that space will likely reflect the full drawdown. But the good news about that is that asset allocation is really the best protection against equity market drawdowns. So, just expect that a full market drawdown would occur since we are passive now in that space. But again, still think that's the right move from an efficiency standpoint.
Yeah, so Mark, Aaron, and John, the talking heads are all back on the US worldwide topic. And we've always been significantly US centric. And it's paid huge dividends to us. Is that something we need to start thinking about going forward? Unwinding that bias or considering that bias? What are your, RVK, what are you thinking? Bigger picture across a lot of different clients, and then John, what are you thinking for our portfolio?
I want to let John talk. There are arguments to have a bias toward, to some extent a home bias because your liabilities are denominated in dollars. But I'll let, there has been a bigger run in US equities versus international. I think you have, at least in terms of, where you're funding, sort of rebalanced into international equity by selling more US equity to fund distributions. But I'll let John comment on that.
So a couple of things. So we have changed our position somewhat over the last few years. So we used to be even heavier in domestic equity. I want to say we were probably 34, 35% at one point in domestic equity. That's come down to 30 as a midpoint. We, not this last November, but the prior year, we increased our international equity exposure a notch from 16 to 17. And so I think we've done some of those types of things already. And I guess finally, I might say, if I'll maybe point you to page 9 on RVK's the big book, the quarterly investment analysis. So at the bottom there, they've got some charts that, a chart that shows the different asset classes. These don't match up perfectly to kind of how we think of it. And so again, there may be some bias in how some of our peers classify these sorts of things, but you will notice that we are actually above the median in global ex-US equity. And we're pretty close to the median, just slightly above the median. I mean, I know we're 38th percentile, but we're only about a percentage point above our peers. So I think we're in a pretty good position there. And you might ask yourself, well, how can we be sort of above in both of those categories? And I think the answer there is sort of back to the hedge fund comment of, well, we don't do some of those types of strategies that our peers do. And I would say from my perspective, and at least historically this board's perspective, that I would rather be in those strategies that we understand and have our arms around the risk that's involved there, as opposed to hedge funds or other things like that. And that is sort of, I think, the difference in our overall equity allocation. Could we go further in terms of, international? Because you're right, a lot of our peers are moving that way. And if you look at sort of the valuation metrics around international versus domestic, certainly international looks a bit more attractive now. I would just say at the margin, as we've done rebalances and things here more recently, I kind of let domestic, well, we've been quicker to trim domestic equity, I should probably say, leading up to this most recent quarter, and let international run a little bit. Not in any significant way away from the midpoints typically, but, probably quicker to trim domestic equity because knowing that it was highly valued, maybe less so.
Private equity is tilted. It seems to me to be tilting toward international.
Private equity? Yeah. More so than it has been historically, I think, as a broad category set. Probably true.
But if you look at page 60, the big book, since inception, our international equity is less, we're getting less return than we are from our core fixed income.
Yeah, international equity has not, over the long term, been a particularly
Do you
good
remember about a year,
performer.
2 years ago, 3 years ago, you said, why are we in international equities at all? Do you remember that?
Right.
Yeah.
And I was told that it's because it's a great thing and it's had a bad decade.
Yeah,
And then my question is, how many decades do we?
Well, I would guess going back to sort of some of the, other discussions we had, if we look at the 10-year return on international equity, it's almost 8%. It's our actuarial hurdle.
This is gonna sound funny, Carl, but I try to do this as much as possible. When you're managing a plan like this, you gotta pretend like you're immortal. And I know 20, what was it, 25 years at this point? That seems like a long time. It's actually not that long. But yeah, it is frustrating that international equity for 25 years has returned less than fixed income. That's
No, I get it. I mean, it's just, I don't know how long you wait. I mean, I don't know how long you wait.
Well, yeah, and here's just food for thought, I guess, on a higher level. If you kind of look into the weeds of, say, the domestic equity market versus international, big portion of the reason that the US market has done so well is because we have a very strong tech sector in the US. And so kind of when you think of that value growth biases that we talk about on occasion, the US market overall is very growth oriented, whereas the international market tends to be more value oriented because it's more of the traditional commodity type plays in those markets. No, that's just a very broad, high level statement if you kind of look in the weeds of sort of the sectors and things there. And so that's driven a lot of the outperformance of the domestic markets over the last couple decades, probably. And maybe that will continue to be true. I don't know. But there certainly is a diversification component, I guess, is what I'm saying, between international and domestic. And so it's not, I guess, as simple as looking at, domestic and international and thinking of, well, it's the same market. It's just, one's in the US and one's outside the US. They're very different in their compositions. And at times in the past, been kind of in the distant past at this point, that has been beneficial from a diversification standpoint. And that's why I think you continue to invest there and have those. And so it's sort of a different risk adjusted return, I guess, if you will, from maybe the international space versus the domestic space. And still, again, good overall returns, at least over the last decade, good enough that you're certainly meeting your actuarial hurdle. And
Yeah, and the only other thing I'll add is there could be some time period sensitivity here too, where you got in, sort of in the .com boom era, and then you had a couple crashes in there too, where you don't have that in domestic equity. I'm speculating. I don't know that fits out in the numbers, but there may be some time period sensitivity here as well.
And one other thing I'll add, I think your relative splits are in line with the global equity benchmark. So generally speaking, that's what we try to do, just to avoid any kind of tactical weightings. So I think, maybe you could consider moving a couple percentage points over from domestic equity to international, but, it's kind of with market performance that may even itself out as it stands.
Yeah, I forget that's a good point, Aaron. I forget what the numbers are. You are a little overweight US equity, but it may not be as much as I think it's the high 50s maybe for US equity would be kind of globally neutral, and you're at mid 60s, low 60s. So I don't think you're too far off a global allocation.
Yeah, the global benchmark has 60% US equity and you have about 62%.
Oh, yeah, I mean, you're almost right on target.
Yeah.
Okay. Well, thanks, guys. Anything else?
Thank
John,
you.
Ready to move on then?
Thank you.
Thank you.
Thank you. So we're gonna move to tab 6. Is that right?
right.
Okay. We're a little ahead of schedule. You want to take 5 before we do that, or is everybody? Let's take 5. I mean, literally 5. All right. Okay. The recording's in progress. There's Diane. All right.
All
We're
right.
on tab 6.
Thank you very much. So I am in tab 6, investment updates, page 4, retirement plans net performance. Over the last year, as we've alluded to, Mark alluded to, very strong year-over-year performance and strong value add over and above the net cash needs for paying benefits. You know, Mark's talking about we should prepare ourselves for the down markets. Well, I think they've already arrived a little bit so far in 2022. Certainly could get a little worse, I'm sure, but we have had a little bit of reversal so far in the quarter, as I'm sure many of you have noticed. But really the most important number, as always, is to really look out to the right, to the long-term returns. And in that instance, certainly significantly significant returns above the net cash need over the long term, and that's really what we ultimately want to see. So moving to page 5, breakdown of all the various asset classes here. This story hasn't really changed much over the last several quarters, I don't think. Generally speaking, tapping domestic equity as it has had an excellent run to pay benefits and rebalance a little bit. Private equity in particular, venture capital, as Michael's talked about in the past, we've seen very high realizations there over the last year or so. And so there again, using that money in some instances to reallocate to other asset classes or pay benefits. An increase in real estate over the course of the year as we sought to put a little more capital to work there, and non-core fixed income as well, maybe being the other relatively big one. But I would say more recently, probably for the first time in a long time, during this quarter, the most recent quarter, which isn't reflected here, actually added some back into domestic equities. It's been a while since we weren't taking some money from domestic equities, but we were down almost 10% on the S&P, call it late January, I believe. And we ended up 50 million back in, just to kind of rebalance back up towards the midpoint at that particular time. Happy to answer any questions on any of that so far.
Oh, you know, we talked about it in asset allocation, but private investments and real estate depends on the pacing and stuff like that.
Yes.
Are you able to keep that pacing up or whatever, to look at those assets? Maybe.
Absolutely. We haven't, yeah, I mean.
So this is just saying.
So Michael and I'm sure we'll talk about it more as we go along, but you know, certainly no shortage of managers coming to us with new funds, fresh capital flowing into those asset classes. But yes, we have been pretty steady. I don't recall exact numbers off the top of my head, but you know, we kind of incrementally increased that the last couple of years. I think we went from 400 to 450 kind of for this year, sort of given where the growth of the overall portfolio has gone, but we haven't made any, you know, big jumps there or big declines in what we're putting to work on a regular basis, kind of steady as she goes. Turning to page 6, similar to the prior page here, but this is just the breakdown for the individual pension plans. Obviously, as always, PERS and TRS, the big ones here. All the plans, you know, slightly cash flow negative, which is again typical, and no real reason for concern. We've been more than able to handle that as they need to pay benefits on a regular basis. Turning to page 7, overall performance, you know, excellent double-digit performance here for last decade, which is, you know, to echo Mark, I guess, would not expect that going forward. That's pretty exceptional. But the more important number here, of course, is the since inception number, which more than meeting our actuarial hurdle over the long term. All right, moving to slide 8, breakdown of performance across each of the individual asset classes. Again, excellent performance across really pretty much all the asset classes. The only thing I would really call out here, we're always talking about it, and Mark mentioned it as well, but you can kind of see the catch up, I guess, if you will, here from private investments versus domestic equity. You'll recall, you know, from the last few quarters, domestic equity was outperforming. Now private investments valuations are sort of catching up, and that's probably true of real estate as well. So strong returns across all of those areas of the portfolio. Questions about any of that? All right, slide 9 is our ranges and the deviation from the midpoint of the range. You can see we're pretty tight to that across the board, not more than 1% off. And you know, just general rule of thumb, I think I mentioned it before. If we start to get kind of more than 1% away from a midpoint, probably that's time to rebalance, you know, I might let it run. We've got some strong belief there some way or another, but we tend to just kind of do that pretty regularly, and most of the time that happens over the course of derivative benefit payments. That's usually an opportunity to sort of rebalance because we need to move some money around anyways.
Now, you do that like on a, when you're looking at this deviation from the midpoint. I mean, this is as of some time specific on 12/31.
This is as of 12/31,
Period.
but I can see this every single day.
And you can see it every single day. So is that, so what are you looking for? Like a week or 2 weeks or a month or?
Well, so monthly we have to pay benefits. So
Right.
there's cash that's going out the door at that point in time. So that is oftentimes an easy catalyst to say, well, I need to pay benefits and I need to raise some money for whatever reason. And domestic equity is doing really well and they're, you know, well above their midpoint. So maybe that's the place I'm going to take it from, or conversely, they're not doing well. And I go talk to John and say, you know, core fixed income, I need you to give me some money because I'm going to put some, you know, either pay benefits or I need to put some back into domestic equities. But I guess to answer your question, there's no set time frame. There are months where cash has simply rolled in because, you know, maybe private equity pay downs are happening and we get to the end of the month and I don't need to do anything because we're not particularly far away, and, you know, why incur transaction costs?
Right.
So there's kind of that balancing act between let's not incur a lot of transaction costs, but let's not stray too far from what our long-term strategy is either.
But I mean, we pick these quarterly dates because you got to have a date upon which. to
Yeah,
launch.
for in terms of
I get
reporting to
that,
you.
but I
yes,
mean-
absolutely.
I mean, in theory, at least, that domestic equity, for example, could have been 2 points above the midpoint for the whole quarter and then.
And you
for
wouldn't
some-
know the difference because all you're
Right,
seeing is
because
one
we're
day.
only seeing. it
That's
on-
right. That's true. It wasn't, but yes.
That's partly where I step in. On that provision you built in of if John is straying from your strategic asset allocation in a meaningful way, my job is to bring that to you. So as John's tracking it, we're all tracking it. Fixed income is particularly tracking it for the cash movement portions of it. That's a place where, you know, if he's out, you know, 2% or something outside of it, then we'll have a conversation. But the bigger issue is for John, frankly, the last year, we've had so much cash rolling in, it's where do we put it?
Right.
And so,
Yeah, I mean, so I guess to answer your very specific question, maybe we've never deviated from the approved board ranges. And if we did, would certainly bring that to you.
No, I
But
get
we've
that.
also
I
not,
just.
we've
I
also
just-
been within a pretty tight band around the
Okay.
midpoint over the entire course of the quarter, and I would say the entire course of the last year.
Oh, okay. Thank you.
So, Mr. Chairman?
Yeah.
So given these, where you're at currently, midpoints, and talking about, okay, we're not gonna see the kind of, anticipating we're not gonna see the kind of returns that we have in the last year. You guys have discussions about where you want to make your allocations, what you're going to do about these placements here? You're gonna just let it run and see where it goes? And what corrections are you you're gonna make?
We do a little bit, but keep in mind that there are only so many levers we can pull here. Right? So to Jack's question about private equity, but extend that to real estate and real assets for the most part. There aren't a lot of levers where I can affect immediate change if I wanted to there, because we can't just go start putting money to work. And conversely, if the equity markets are selling off and they're moving up in the range, it's usually just a denominator effect. So most of the discussion typically centers around, well, what are we going to do for, you know, public equities and what are we going to do for fixed income? Because those are the ones that I can affect most readily.
Okay, but according to this, you have some room, you know, real estate, I understand that, but you are real assets, I guess you got some room there, but but you also mentioned non-core fixed income. Now, there are things that you can do there.
Yep.
So,
Fairly quickly, yes.
But you're not really approaching that at this point.
Well, so like non-core fixed income here, almost 1% underneath. To be honest, primarily thinking of that, we're still looking at the convertible strategy. We've kind of gotten a narrowed down list there, so I would expect that in the next, few months, we'll put some money to work in that space, which would bring that up.
Anything else?
Any other crazy things we can expect?
I try not to bring you any crazy things, Jack.
Very
Or any
good.
surprises, right? Right?
Well, we may remember the last one, and we certainly don't want to repeat that.
No, none of us do. Moving to slide 10, economic environment. In keeping with Mark's advice, I try not to ever, make predictions when I'm telling you all of this. This is just sort of an information of where are we at now. So looking at slide 10, annual GDP, the forecasts that are out there are generally moving back towards the longer term trend. So we saw obviously the huge dip in 2020 from COVID, huge rebound, and then kind of moving back towards what might be considered, I guess, more normalized GDP. Now, as Mark said, there's a lot of levers there that have to fall into place and go well for, things not to go poorly or perhaps better, I guess, than what might be expected. And so there is a lot of debate in the market right now about what growth expectations are going to be over this time frame. I would note, though, at the, currently at least, growth expectations, even though they're coming down, are still a little better than what we experienced for, the prior decade coming into COVID. And a lot of that is the stimulus and the economic growth that's been generated from a lot of that over the last few years. So, we'll see what happens. Certainly concerns about inflation and about the ability of companies to pass on their higher costs and affect their margins, and how the Fed's going to react to all of that. But something to keep an eye on a day-to-day basis. Looking at slide 11, just a couple of things that I thought were interesting broadly that are happening in the economy. I think I've shown at least versions of sort of the good services slide before, but the huge spike that we've seen in demand for goods versus services over the course of COVID pandemic. But you can see that services has kind of largely recovered for the most part to this point, and goods is still pretty elevated there. So a lot of supply chain issues and things that we've talked about previously, and we're seeing, some signs that some of that is easing. So hopeful that that abates somewhat, which should help some of the inflation expectations. But there's also some structural issues there. One that Ethan's probably talked to you about prior is, some of the industrial space that's out there and around the ports. And because of this demand for goods, there's very limited supply for warehousing and that sort of stuff around the ports in particular. That looks like kind of a long-term structural problem as we sort of move to that, Amazon model, I guess, if you will, where everybody wants to order something online and you want to have it at your house tomorrow, and they've got to have infrastructure there to ship all of that type of stuff. So there's still bottlenecks and things that may, be structural and persist for a longer period of time. But it's, one of those metrics, again, that we kind of keeping an eye on and seeing how that progresses over time. Single family housing, I pulled this one out because we've sort of seen this in the past in some way, shape, or form, but there does seem to be a shift more recently in the behavior of people in regards to home ownership. So home ownership had really dropped as sort of a percentage of the population. Particularly the millennial generation was sort of less excited to own a home, and that has flipped, and probably not just for them, for obvious reasons. During the pandemic, people probably want some space, and ability to work from home and all those types of things. And it's notable, I think, because homeownership tends to drive a lot of other economic activity. So you buy a new home and then you got to put in new carpet and you want new furniture and you need drapes and whatever else it may be. So it does tend to be sort of a driver of the economic cycle in a longer term way. Questions on any of that? All right, moving to slide 12. Getting to kind of the Fed and interest rates more generally. Interest rates are clearly rising. Market is expecting 4 to 5. I would say maybe it's even 5 to 6 hikes at this point in 2022. So, one of the things that will be interesting, I guess, going forward, Mark talked about, higher rates do lead to potentially lower valuations for assets, because if you're looking at that sort of discounted cash flow model when you're valuing an asset, higher rates would bring that valuation down. But a lot of that is baked into the market at this point. So there is an expectation already that the Fed is going to raise rates. And we have seen a commensurate reaction, particularly in the stock market, of lower valuations this year. Does that have further to go? I don't know. But there's kind of, I think, starting to be an argument that that could go either way. The Fed could maybe not be quite as aggressive as what the market is baking in, and they could be more aggressive. And, so who knows which way that goes, but I guess I'm just pointing out that some of that's already happened, so could we have another 10% drop in the equity market? Sure. Not predicting that, don't know, but there is a fair amount of it that's sort of been baked into the assumptions at this point. And I guess, by the way, I printed this out at the end of January. Rates for the most part across the board are probably 25 to 50 basis points higher than what I've got in this. Similar curve probably to what I've got with the green line there, but they're even higher. So the 10-year, at least as of this morning, was 204. It was 175 or something. It was chart. So rates have gone up even further. Moving to slide 13. Again, Mark alluded to this a little bit, but volatility broadly within the market has been picking up, and that is really driven by the uncertainty that's out there in terms of what the Fed's going to do, and the company's going to be able to weather their way through this. So we have seen a pickup in volatility. It's hard to imagine in some ways that the Fed's going to be able to engineer the quote unquote soft landing here, because they're trying to raise rates just enough to not kill the economic expansion, but to dampen inflation. And that's going to be it's a fine line to walk. So, that there will be, I think, highly likely that there will be some missteps there, and we'll see increased volatility throughout 2022, if not into 2023. So I would agree with them. Expect, maybe more difficult, painful meetings at times. So nothing to worry about long term.
So you're saying that we have to go through that pain, John? Or
You have to go through it when I report it to you, and I have to go through it on a day-to-day basis.
Yeah, so John, I haven't heard you or Mark, maybe I just missed it, mention the word Ukraine any place.
I was given there, Bruce. Yeah, I mean, geopolitical tension is arguably as high as it's been in quite a long time. One of the very hardest things to predict, of course, in the market, wouldn't even try. I will say that typically that pain can be pretty extreme, but it's also usually fairly short-lived. So it's not something that it's something we are certainly constantly looking at, but we wouldn't change our strategy or how we would think about things overall. And Ukraine's a good example.
Well, and
Yeah.
he answered what was going to be my follow-up question is what do we do about it, which you're saying.
Stay the course.
Yeah, and I would agree with John. If there's anything normal about history, it's war, unfortunately. And they are, you know, unless there's nuclear weapons involved, which I highly doubt there will be. You know, this is an unfortunate normal flaw of humanity, I guess. And we've been through these disruptions before, that there may be some short term. How to time that, you know, is anybody's guess. So we'll try. Yeah, I mean, it's not something that we would anticipate affecting the long-term strategy of the plans. And if it gets to the point where it would, we probably have bigger problems to deal with. That's a good question.
Anything else? All right, turning to slide 14. Just like this one, it was from our emerging market debt manager, but you know, just kind of puts things in perspective, I think. A list of significant drawdowns in the market. This again was, I think, late January, this particular slide. Oh yeah, as of 128. You know, at that point, we were down not quite 10% in the markets and the S&P 500. I guess this one is specifically, but you know, that's not unusual over the course of time. So I know it sometimes feels and looks very painful when you're looking at a lot of red on the screen, or valuations have gone down what seems like so much, but you know, it's quite a frequent occurrence. And I know I've shown other slides where I think the average, you know, drawdown year to year, kind of intra-year, it's something like 15%, which you usually, you know, most years rebounds and ultimately has not much effect on the overall return that you got over the course of the year. But, you know, in that day or week or month that you're looking at it can seem pretty painful, but just one more reason to stay the course and not shift your long-term asset allocation.
What's interesting to me is to see the number of days.
Yeah.
It was shorter than I would have thought.
Yeah. It feels pretty painful when you're in it. When you lose $2 billion the first month that you're CIO, that 45 days or so feels like an
13 days.
eternity.
You're an overachiever, 13 days.
13 days, yeah. Good times. All right, turning to slide 15. A lot of this is similar to what I've said prior quarters, you know, investment challenges. We've talked about it pretty much already. You know, certainly more uncertainty maybe around global growth and the path of monetary policy than we've seen in quite some time. I would expect increased volatility going forward. As you know, we completed the restructure of the domestic equity portfolio to the passively managed investments. Mark had a good reminder there that while I do think we will track close to the index, you will recall that we do still have the ability to over or underweight, you know, small cap, large cap, and we are in fact a little bit overweight small cap at the moment. And so, and I guess in addition, you know, regardless of whether it's passive or something else, there's still fees attached to it. So there's still a little bit of a fee drag. It's much less than when you're in active management, but that is a factor still. Obviously continue to look at a number of new public and private manager opportunities. As I mentioned, you know, no shortage of opportunities coming through the door here, and Ethan and Michael and things will talk to that more as well as Jason.
Just a question on that. Are any of these people traveling yet? Or
They are.
They are. So
Absolutely.
would
In
be
fact,
your people.
I probably had 3-4 meetings in the last month or so where they were here. We've kind of kept it to ones that we have an immediate direct interest in, or you know, maybe are a very important manager for us or something. We're not just taking, you know, every manager meeting. Ethan and I have traveled a couple of times already this year, so yeah, we're full on. Completed our search for the Director of Public Markets and our Private Investments Analyst, and student intern search is in progress. We did our first screening a week or so ago. We've got about 10 interviews set up for the first week in March, and we'll look to hopefully get 2 interns for the summer as we have been. So process improvements, custodial contract, and analytic tools that are associated with that. So, kind of starting to scale up here and hopefully learn Solovis and some of the things that we have on the plate there. We have completed the process of being able to trade ETFs on the Bloomberg platform in competition. And so that was a little painful, but we got there and all good. We need to work a little more on kind of doing more cross training and getting more backups there. Right now, Jason and I are the only 2 that can do ETFs. We'll probably add John Ramasco to that mix as well, just because he's got a Bloomberg terminal. He's used to trading in things, and Steve doesn't. So and don't want to pay for another Bloomberg terminal just to have Steve do that. We are reviewing due diligence processes across the board. I mean, I guess we always are to some degree, but both Michael and Ethan's team are taking a look at the kind of the ILPA template, the Institutional Limited Partners Association that we belong to. They have information that's out there every so often as to sort of what the rest of the industry is doing. So kind of going back and refreshing and seeing if there's areas there that we need to add things or improve. And Jason's doing kind of a similar dive in public markets to look at our process there and see if there's things we could be doing better or differently than what we might have done in the past. So happy to answer any other questions. If nothing, I will turn it over to Aaron.
Good afternoon, Mr. Chair, members of the board. I am on the macro attribution key observations page. I say key observations rather than that keyword because it's been used in almost all of our contract negotiations, and the executive director has all but banned its use. Beginning on strategic asset allocation, kind of the same story.
Aaron's strategy is just run. It's a fight. It's flight.
I'm just. It's just, I don't know that for a fact. But I'm just
Thanks for
guessing.
stating the obvious. Appreciate the vote of confidence, Mr. Chairman.
So kind of the same story as it's been. All benchmarks performed well, with the exception of core fixed income, which led to our pension policy neutral return of about 14%. Domestic equities was once again the largest positive contributor. Moving on to tactical. On average, we were slightly overweight domestic, international, and real estate, all which had positive returning benchmarks, therefore added positive tactical allocation. But those were offset basically by our underweight to private investments. And it came out to, on a net basis, an uncharacteristically low 1 basis point net amount. Wouldn't get used to it being that small. Our goal is to keep it as small as possible because we're not trying to deviate from the midpoints very much, but that one is unusually small. Moving on to style selection. Other than what is written here, the only thing I would note is I neglected to put some notes for real estate, and there was some underperformance from a style perspective based on our CMBS exposure through a commingled fund in the real estate portfolio. And that contributed to the majority of it. The manager selection, again, other than what's written, the only thing I would point out is that in domestic equity, we should expect to see some manager selection effects for the next year, at which point, the 1 year performance will, trailing 12 months performance will all have rolled off, and it should be basically non-existent for the most part. private investments, if you were to look at its contribution this year, it's about 2.8%, which is a massive amount. But if you were to look back to December 2020, that was negative 2.3. So I just think it's a good illustration of, the way that when private markets catch up with public markets, and it's not something we should expect to see, every quarter going forward. Any questions on macro attribution?
So once we get the end, the act in, then this 3.8% number, right, shrinks to always zero?
Once the domestic equity active managers roll off, there just won't be a contribution from the domestic equity managers. So, rather than 3.8, it would be, 3.5. So it would just, the other manager selection effects. will still
Oh,
exist.
okay.
Any other questions? Thank you.
Is Michael on? Michael, are you online?
No.
No. He's on vacation, so. All right, I'm gonna do private investments. So a whole lot to talk about here. This is pretty similar to what it's been over the last several quarters, but deal flow has been extremely strong. We've seen a lot of managers coming back to market quicker. Part of that is kind of like I talked about, higher realizations within the private investment space. So, they have essentially seen the opportunity in the public market, and they are, actively selling investments and turning things over. So we've seen kind of the quickest churn that we've ever seen within some of these funds, of them going through the process of, buying companies and then fixing them up and selling them. That has all kind of been accelerated. So they're coming back to the market, again, quicker than they probably have. Beyond that, I would say, generally speaking, yes, valuations are a little bit elevated in the space, but not ridiculously so. It varies certainly across managers as well, depending on if you're looking at the, maybe some of the ones you see in the press that are raising the 10, 15, $20 billion funds. They're playing in a space where they're going to have to pay up because there's only so many big deals that can move the needle for them. Where they tend to play in the smaller to mid-tier type space where hopefully they have a little bit more opportunity to differentiate on pricing to a degree at any rate. Slide 20, performance, strong across the board, very additive to the overall returns of the portfolio. And, a lot else to say there, I guess, similar to what it's been.
Is there any managers that you'd want to point out to us that have really hit it out of the ballpark, or that you're more pleased about than normal? I mean, I don't want them to get a big head if you hear the notes, but.
I guess I don't know that I'd call out any single managers or that anybody comes to mind off the top of my head. What I would say is like venture capital, as an example, has had just, stellar returns because they've been able to IPO a lot of assets, to the extent that we have exposure there. As we've talked about, it can be a tough space to get exposure to at times, particularly the right kinds of managers. But they've been a real standout in the recent term here, I guess, over the last year or two. Ton of realizations there. So that'd probably be my main comment. I can't think of anybody that I would call out specifically, I guess, in terms of individual managers. Characteristics and activity, total market value, 2.26 billion. Again, valuations have gone up kind of commensurate with the rest of the portfolio. So we've sort of kept pace in terms of a percentage weight of the portfolio there, which has been helpful. Cash flow, very strong. I think overall cash flow for the private investments was a little north of 200 million over the course of the entire year. So you can see that the fourth quarter in particular was a pretty strong returning quarter for us in terms of capital coming back to us. And we already talked about the two commitments there. Other questions about private investments? Right.
Okay. Mr. Chairman, members of the board, thanks for having me back. I'm on page 22 of the presentation to talk about real estate. I'll be brief and just draw everyone's attention to the final bullet point there. Things are pretty much firing on all cylinders for the most part. There's still some trouble and uncertainty in office, hotels, certain aspects of real estate, retail, but valuations are up, REITs are performing. We saw record-breaking transaction volume last year. The debt markets are open, interest rates are on the rise, REITs are performing, very strong capital fundraising environment. Fundamentals are super strong for the most part, even in those troubled sectors. Office occupancies are going up, just albeit at a muted rate relative to some of these other stories you're hearing around multifamily, self-storage, industrial, for example. Certainly happy to address any specific questions to the extent you have any, and I'm able to answer them.
Are you concerned that it's kind of a post-COVID bubble?
A post-COVID bubble.
I mean, as people get to
no,
come out of their houses
Yeah.
and look at the second home they bought in Montana and realize that, oh crap, there's winter there.
Yeah, well, that's a different part of the real estate market, one which we don't play in. And so there certainly might be some of those oops moments with regard to residential real estate and trophy homes. But, if you look at multifamily, for example, there's a lot of fundamental support there when you look at the housing shortage, affordability. People just can't buy homes. They're laden with student debt, for example. Homes have appreciated 10 to 50% depending on the market. People can't afford down payments. The list goes on. Industrial is super interesting. You wonder how long will this e-commerce craze last? Well, there's questions around that, but a lot of people think it's going to continue for the foreseeable future, and that's buttressed even further or bolstered even further by a lot of the onshoring that's going on and people shifting their business models from just-in-time inventory to building up stock onshore to fulfill orders. So, I don't think this is a bubble. Real estate is clearly cyclical. There's no doubt about that. I've been wondering when the music's going to stop. I guess I started in real estate in 2005. So I lived through the GFC. That was driven by supply and demand, some oversupply, and then, leverage, which cratered a lot of stuff, and, the housing crisis and subprime and a lot of that stuff trickled in. But, the fundamentals are there in a lot of places, places where we focus on, and other places we focus, like grocery anchored infill retail. That's needs-based stuff. People need to go eat. People really thought maybe bricks and mortar retail grocery stores were going to be displaced by an omni-channel or, cold storage delivery services and groceries landing on your front porch. And while that's certainly a trend that's happening, by golly, grocers have increased sales by over 4% in 2021. Our retail portfolio performed exceptionally well throughout the pandemic, 95 to 99+%, rent collections, occupancies were maintained. There were no defaults. Medical office, people still break things and get sick in good times and bad. And, there's good credit there, there's long duration leases, they're triple net, so tenants are paying all their taxes and insurance and tenant improvements as examples. So, I'm trying to focus the portfolio on property types that are, look, nothing is absolutely not exposed to cycles. But I'm trying to mitigate that by focusing on things that are needs-based, that are supported by strong, durable fundamentals and demographics. Those property types that aren't as exposed to the cycle, like office and hotel, that have higher net operating income margins, require less capital expenditures to maintain through time and thus have higher margins. That really boils down to sort of medical office, grocery anchored infill, multifamily, industrial, sort of across the spectrum. Maybe some self-storage at some point. Life sciences is another maybe topic du jour. There's a lot of buzz in that space. I tend to get a little bit worried about that when there's
Life science.
life sciences. Think lab space in an office building with a company that's developing drugs to fix what ails you. There's a lot of durable spending trends there. There's something like 800 ailments that haven't even been fully addressed. So there's a long sort of ramp in this. I tend to get worried about capital flight and the topic du jour. And that's why I kind of think about multifamily and gave you some of the fundamentals there, and industrial and some of the fundamentals. And if you can wrap your head around that and get comfortable, I think there's room to run. But I'm trying to be risk averse. I'm trying to be risk cognizant. I'm trying to innovate the portfolio around the edges with these separate accounts because I think the closed-end fund model is sort of fundamentally misaligned and favors the GP versus, someone like us who operates theoretically in perpetuity. And if we can buy good real estate and get good cash flow, we should never trade it. We should keep it forever and avoid the frictional costs of buying and selling. And taking the reinvestment risk of recreating those amazing portfolios. That just makes zero sense to me. So anyhow, I digress a little bit, but hopefully I answered your question.
No, you did. That's great.
I have one question on risk. We had problems on a property in Nashville.
We did.
How did that all turn out?
So we have received $17.1 million from that investment to date. The structure has been stabilized structurally. And I believe the GP actually has it on the market to sell. And that 17 million that we received was actually, if memory serves, more than what the property was valued at prior to the Christmas Day explosion. So we're doing pretty good on.
So it's working like it should have, really.
That's why, we spend a lot of time in diligence and we talk to managers about their insurance policies and, business interruption, yes, it's working like it should have.
So back to that question, I thought one of the buildings was torn down.
It wasn't torn down. It was substantially blown up and part of a big strip that was essentially one contiguous building with, certain walls demarcating different businesses. And it was, destabilized. And, they brought engineers in and instead of, they determined that instead of, whatever, carrying it down, forgive me the term. Thank you. They structurally reinforced it and they're gonna ultimately, some developer will buy it and redevelop it. Yeah. No more questions. We can keep moving. The next page is performance. A great year, to be sure. Sort of speaks for itself, but if you have specifics, I can attempt to address them. Let's hope that continues, but it won't. So don't get used to 20% returns year in and year out.
Do we have a ceiling on leverage?
Yes, we do. The ceiling on leverage is 65%
And we're at
portfolio wide, if
47.
I'm not mistaken. Yeah,
Okay.
yeah. And you'll, yeah, sorry, 0 to 60% on the overall portfolio.
Okay.
Yep.
Thank you.
You're welcome. So page 24, you all have seen this before, so forgive me for, rehashing this quarter in and quarter out. US centric, diversified by property type markets, focused on operators, although we'll always have allocators likely. We're getting close to establishing our first separate account. I'm happy to say I'll probably have that in front of the decision-making corpus here next month or early April. Continue to focus on our high conviction managers. We had a pretty heavy negative cash flow for the quarter that was driven by a bunch of big capital calls, one of which was on the order of $36 million for the Stockbridge Niche Logistics Fund that we committed to maybe October of 2020, if memory serves. Proud to say they've drawn all of our capital there, both $80 million from CAP and another 50 from Trust Fund, if I'm not mistaken. And that fund is absolutely going gangbusters. I think they did almost 9% net in the fourth quarter alone. So that's been, capital's been deployed and it's working for us. And that's what we like to see.
And what are they buying?
They're buying logistics oriented infill industrial assets that include things like, distribution centers. So, cross-docked distribution facilities. They're buying lay down yards with truck parking, truck terminals, maintenance yards. They're also buying high distribution, bigger box, high velocity facilities. For example, I toured some of the assets that we own just outside of Savannah, Georgia, which is one of the largest ports in the United States, and everything was 100% occupied. They were bursting at the seams, filled with. I walked into one industrial building and probably from ceiling to floor, maybe 200 yards long at least, there were Red Ryder wagons. Thousands of them. It was just mind-boggling, and so it was, yeah, but that's what they do.
Huh?
Kids need those.
That's a. Need to get them on a boxcar and get them somewhere.
Yeah, no new commitments, but rest assured, I've got a full docket for the year, so stay tuned. I'm busting at the seams myself and pulling my hair out, but it's self-imposed, so please don't feel sorry for me. Our leverage profile is here. Everything is within constraints. Happy to answer any questions.
Just quickly on the leverage, so 60 or 65 is the limit.
60, 0 to 60
So
for the
is
total.
is that the roll-up number, or can Core Plus go to 80 and the rest be?
So core, so this is interesting. So as of this date, well, let me think about that. So the 0 to 60 is the rolled up portfolio. And so that 47.6 is the total portfolio view, including everything. Debt is 0 to 75, core is 0 to 50. We actually just moved core from non-core up to core plus, so that leverage ratio of 0 to 50 will apply to core and core plus blended together going forward. And then non-core is 0 to 75% on a sort of an aggregate basis.
Thank you.
Yeah, of course. Anything else? Otherwise, we'll roll the real assets. Okay. So again, as I like to do, the summary points down below. Oil's been on a tear. That's really a supply and demand issue. The recovery happening faster than people thought it would. People, not overreacting relative to Omicron and so forth. So anyway, just positive outlook there. Inventories are at all-time lows, so supply is really low. Recall Saudi Arabia and OPEC pulled something like 2 or up to 4 billion or million barrels off the market. They're having a hard time getting that oil back online and meeting their quotas, to be frank. And so there's just not a whole lot of oil coming back from the supply side. The folks that are sort of onshore here in the US, a lot of the shale producers are not, while rig counts are growing incrementally, they're really there's been a mantra in the market over the last probably 5-10 years. They've been sort of growing for growth's sake at the expense of, positive cash flow and dividends to their investors and paying down debt. And that is reversed. And so instead of growing and, increasing their production and proven reserves, they're really restraining themselves and focusing on paying down debt, curing their balance sheets, and returning cash flow to investors. So there hasn't been a whole lot of development going on in the US either. So that's the quick story there. MLPs had a wonderful year last year. They're up 11% this year to date through January. Construction spending was healthy. Demand and pricing continue to be resilient in the aggregate space. Lumber is back up to sort of all-time highs. Recall it ran clear up to about $1,400 a board foot. Since sold off quite a bit and then is back. I haven't checked it recently, but it's well over 1,000 still. So that bounced back like a lot of commodities. Housing's very strong, lots of dry powder. Questions? Okay. Again, performance is there. I will attempt to address any questions, assuming there are any. Seeing none, I'll just keep flipping here. Excuse me. At the top of page 27, we've got real assets broken down by their sort of individual exposures. Again, North American centric with growing international exposure with recent commitments. We talked about the rail fund leverage is within constraints on the timber portfolio, and Terry, timber can be 0 to 30. And in fact, actually, that's pretty timely. ORM Fund 4, which is now BTG Pactual Fund 4, is ramping up their leverage. They're going to be financing, I think, a $33 million dividend back to LPs by levering the portfolio. That still keeps it, I think, at 12% loan to value. So really still quite conservative. Plenty of cash flow generated from timber sales and other sort of higher and better use sales to service that debt. So no concerns there. And actually it'll be a return of capital to us at scale. So that's encouraging. And we participated in that discussion and approved it based on sort of the proposal. So if we were the least bit uncomfortable, we would have nixed that. But happy to see some capital coming back for sure.
So the idea there is that it's time to get capital back to the investors. Quickest way to do, and if they can afford it, and the quickest way to do it is to borrow.
I did not have that conversation with them. I think they're, they are return focused, and just like every other one of our managers, and part and parcel of generating a rate of return, for better or for worse, is putting leverage on portfolio companies, on real estate, on tracts of timber. And this has historically been an unlevered portfolio for the most part. And they saw an opportunity, they saw accretive debt, they saw cash flows that were more than ample to service that debt. They locked in a rate of 3.04%. That matches the duration of the fund. So asset liability matching perfectly. And, I guess from my perspective, if they could put leverage on there and take a dividend out and pay us a little bit of money, I'm all in favor of that. The timber markets are strong. Last year was a record in timber transactions. I think since like 2005. And so selling tracts of timber is not a problem right now at all. But these are long duration assets. They don't want to sell. There's great site quality. There's great timber. The silviculture methods they employ, that's, fertilization and, weed killer prescriptions. Why can't I think of these words? They're all in place, and sometimes it takes a little while to realize the value of that capital expenditure that you put into these assets. And so it doesn't make sense necessarily from a return on investment perspective to sell right away. And so this isn't just, hey, let's put leverage on to, finance a dividend back out. Certainly that's a nice thing, but that's part of a broader decision tree matrix that they embraced before doing this, if that makes sense.
One of our funds had fires in their timberlands.
They did?
And how did that?
More than one?
Yeah. How is that worked out?
We've also had hurricanes.
Fire, floods, hurricane.
So let's see, on Perpetua, pardon me, which is a Eastern Oregon deal in Fund 4, ORM Fund 4, minor fire damage. In fact, salvage values, it was like maybe 900 acres burned, and it was mostly the understory. So there wasn't any real permanent impairment to the merchantable timber that was on that property. So no harm, no foul there. In RMS 3 down in the St. Joe's portfolio, which is on the panhandle of Florida, there was some fairly significant fire damage. That was 2018, if I'm not mistaken, and maybe in upwards of 10,000 acres, maybe 8. There was an investigation. It was determined that the fire spread onto the property from the neighbor's property. So the neighbor was held liable, and we were ultimately paid out, I think, our pro rata share of a $20 million settlement that equated to something like $2.8 million, which was in excess of the fair market value of the timber, merchantable timber that was on the land at the time. Those are the two significant fire incidences that I could bring back to your attention. I could probably recall details around Hurricane Michael that crushed the Florida asset, but we got paid out on that too.
But just in a high level, if the insurance is there.
Yes.
Protections.
Yes, yes, sir, absolutely. Yeah. Please.
Another topic. Are we done with timber?
Done with fire.
Okay.
I lost track how tips are doing with this inflation now.
That's a great question. I'm going to defer to my tips expert who's sitting right next to me. Or behind me, pardon me.
Tips did well.
They did.
On the year. I don't have the figure in front of me, but I think it was in the mid 7% return.
And I would assume with inflation increasing, we think it's going to be a good year for them, right? I can never quite get that relationship.
So a lot of it's built in already, kind
Okay.
of similar to my other comments that so tips have already, the break even is already fairly high.
Gotcha.
And so hard to say whether they'll do well or not, but
Okay, because it's built in. Okay, thank you.
It's just me that the only sort of fixed income thing that's making money right now, we don't put in Ramasco's portfolio. It's just not fair. Joe. It's not fair.
but he's losing less than Pierce. That's what we're getting. That's what we say every time we walk by his office. Are you losing less
Less of a
money?
loser.
What other questions can I address? Okay, thank you very much. Please.
You kept saying there's lots of dry powder. Were you talking about we have dry powder or there's lots of money out there chasing deals?
My specific comment was related to there's lots of money out there chasing deals. We certainly have dry powder as well. You know, as you know, our commitments draw down through time and not all at once. So we have dry powder as well.
There's still a lot of money out looking.
Yeah,
at this.
it's flush, you know, and it's been that way, you know, I guess almost since I've been here. You know, we've been sitting around the table for years talking about, you know, where do we put money in? I mean, money's just chasing yield right now, and it's chasing yields into the ground across all property, you know, asset types. And, you know, I mean, when you look at treasuries, although they're, you know, let's go to real estate, let's go to real assets. It's, let's go to private equity, these private credit funds. It's chasing. There's a lot of capital out there. Yep, you're welcome. Thank you. Thank you very much.
Thank you. All right.
It wasn't much of a buildup, but
What did you want?
well, something better than he's not that big of a loser. If I can refer the board. to
Now,
slide
losing money.
28.
All right.
Just say that towards the end of the year, things went at least a little closer to our way. Interest rates went up fairly significantly. Wasn't a parallel shift, but more of a shift on the front end. I think as the market started to believe that the Fed would finally react to what have been eye-popping inflation numbers. Fed can move the front end of the market much easier than they can move the long end of the market. And so we saw the front end of the market interest rates go up significantly more than the long end. So 90 basis points up on the 5-year and only 25 on the 30-year. Money market yields were at the time remained very low, and spread on corporate bonds didn't do much at all throughout the year. Little more volatility in mortgage-backed spreads, but they finished the year without pretty close to where they started. So all that said, the Barclays Agg lost 1.54% on the year, and that was again due to higher interest rates. And we know that the value of your bond portfolio moves inversely with interest rates. So as interest rates go up, your bonds value goes down. But it was a more placid environment over the past year than we saw in the beginning of COVID, and saw a strong and robust market liquidity. You can see portfolio performance on slide 30. Again, the index returned a negative 1.54%. The internal portfolio returned essentially on top of that. Reams underperformed slightly. The internal portfolio, a little bit frustrating. We were positioned correctly for the increase in the interest rates. We were not positioned correctly for the twist in the curve. And in other words, we weren't positioned for the 30-year, essentially outperforming the front end of the curve. So seems like a not rational reaction of the market to very high inflation numbers, but that's what happened. So what we got by being short, we gave up most of that by being bulleted on the curve instead of barbelled on the curve. At the end of the year, we remained very short, or not very short, we remained short in duration. We were about 90% of the index, and of course, lately that's worked out well for us. In the core portfolio, we were overweight treasuries and agencies and underweight spread product at the end of the year. In our corporate securities are generally shorter than the index. Any questions on the core portfolio?
Afternoon, Mr. Chairman, members of the board. This is one of those quarters where last quarter seems like old news. So I'll try to mix in some comments of what's happened. Context of what's going on, but starting with non-core fixed income on page 32. So at the last meeting, I talked about high yield spreads were tight. Credit quality of the high yield market was basically as high as it's ever been. Healthy financial system, which was a good backdrop for preferreds. And two, that higher treasury yields and a stronger dollar for most of 2001 was a headwind for EMD. So what has changed? Treasury yields have gone up about 50 basis points this year, leading to more of a risk off sentiment, which has led to high yield spreads widening some. Notable widening, not huge. We're still at relatively tight levels compared to history, but it was a rough January for U.S. high yield. EMD spreads, emerging market debt spreads have widened, but not quite as much as U.S. high yield. And preferreds have suffered some. At the end of last year, there was an influx of issuance, which put pressure on prices. And two, with this year a little bit flatter curve that hurts banking and net interest margins, and so preferreds have underperformed year to date. What hasn't changed is U.S. high yield credit fundamentals are still solid. High yield default expectations are still extremely low, below 1%. Health of the financial sector is still solid. So we have reasonably good fundamentals, but it's been sentiment and technicals that really drive the market. And I think probably we'll see more of that, more volatility, and maybe a market less driven by pure credit fundamentals than other reasons. So page 33, you see the performance. Quarter, our high yield managers added value, as did preferred securities manager. The EMD manager underperformed slightly, and this was the case really for most of 2001, that manager performance was generally positive, but what hurt the relative performance of the asset class benchmark was the absolute returns of preferred securities and EMD. So high yield was up a little over 5% for the year. Preferreds were up maybe half of that, and EMD was down 4%. So that was a drag on the relative performance for the year. On page 34, to recap some of that, we did make a small contribution, a $25 million contribution to our emerging market debt manager in the quarter. And any questions about non-core fixed income?
So it looks like what you said on 32. That the EMD problem is really tied in some extent to the virus concerns and emerging markets.
Certainly. Yeah, there were more concerns in emerging markets over vaccination rates.
Right. And that's not changing that way.
It's getting better.
Is it getting better?
I think at some level, and we talked about this with our manager or actually with one of our international equities managers, that some of these emerging market countries are kind of used to stuff like this, and it maybe doesn't affect them quite as much. But
doesn't affect the economy as much because they go through this more often. Is that what that?
Things are improving, and I don't have the stats, but we've seen charts from several of our managers, international managers, on how vaccination rates are increasing. That's generally a positive. I think generally,
this would apply to kind of global markets in general. You know, EMD has outperformed preferreds and US high yield year to date. It's generally things that are high PE, richer valuation, have gotten sold first. Things that have lagged, less richly valued, have held in a little bit better. And that's a general trend, I think you could say, across fixed income and equities.
Thank you.
Moving to page 35, domestic equity. Remember that stocks did rally in the quarter. If you remember what it was like, 11% for the period, and certainly amazing returns for the year. Large caps beat small caps by a large margin. A little bit of rotation in the fourth quarter after having underperformed for the first 3 quarters. That growth handily beat value in the fourth quarter. What we've seen year to date is a reversal, a huge rotation into value. Large is outperformed, large cap is still outperformed small cap, but by a lesser degree. So we've seen last several years these huge rotations back and forth, pre-pandemic, post-pandemic with growth value. So we're seeing more of that this year. I think the big picture as you look, and I think others have mentioned some of the trends that we're entering a new period. Fed removing accommodation, stubborn inflation is something we haven't dealt with in decades. And more recently, now we're dealing with decelerating earnings growth. We had massive earnings growth last year, and certainly expect much less this year. All those things are generally headwinds for stocks, and that's just the environment we're in. Page 36, and you see the performance. The asset class is about flat in the quarter, but outperformed for the year. Active manager performance was generally positive. The next comment, that overweight to small caps did not help for the quarter or for the year. What did help are up through November when we did the transition, our small cap was probably tilted a little more towards value, and small cap value did better, much better than small cap growth. So that probably helped a little bit, but overall for the year and for the quarter, the overweight small caps was a drag on relative performance to the asset class benchmark. But so we've lagged slightly over longer term. Fourth quarter and last year. Just to add on the comments that going to all passive does not necessarily mean we'll be spot on the index every period. Fees, which are minimal, are a drag. There's securities lending revenue that we can get and other types of revenue that can help offset that. Now, those are relatively small effects. It's talking basis points here, as well as the overweight or underweight or position in small cap relative to the index. That could be a larger effect depending on the magnitude of the overweight or underweight to small caps, as well as the difference in performance. We've seen the last year huge differences in performance between large caps and small caps. So we will not be spot on the index for every month or every quarter or every year. 38, some of the characteristics again, we talked about all passive investments in the asset class. Still have a modest overweight to small caps. We did some rebalancing in the quarter out of domestic equities, and John mentioned a little bit back into is things that kind of sold off. And John talked about the new trading process that we implemented for ETFs, which puts multiple brokers in competition. We've done that and had that process down well, and it's ensuring that we get best execution, which I think is important. How much does that save us? don't know, I don't have a number on how much it saved us compared to, you know, what trades we might have done in the past. It might not be, it's not huge, surely a huge savings, but it's the right thing to do in terms of how do we ensure that we're doing the right thing and achieving best execution. That's, I think, this process of being able to put multiple brokers in competition and getting the best bid. Any other questions on domestic equity? We'll move on to page 39. International equities continued to lag in the fourth quarter in 2021. Some of those trends continued, you know, underperformance relative to U.S. equities. A lot of that's the underexposure or less exposure to the high momentum, high tech, mega cap growth stocks in the United States. And two, the sell-off in China due to regulatory concerns and concerns over economic growth. Year to date, it's been pretty much the opposite. We've had international equities have outperformed. China has held up relatively well. And again, I mentioned a huge value rotation that we've seen in this quarter. And international stocks generally seem to be more value than U.S. stocks, I think you could say. And so that's some of the dynamics that we've seen, at least year to date. Look at performance. We lagged full year, slightly outperformed in the fourth quarter. Really, there was, if you look at it, no dominant theme really. There was manager performance was kind of mixed. But, nothing to really explain, you know, either by market cap or style bias that was a major driver of returns for the quarter for the year. Over the longer term, we've had, you know, and underperformed for the 1 year, but better performance of the 5 and 10 year period. And 42, some of the characteristics that you would look at, you know, we still have about 50-50 in terms of active and passive split in international equities. We have a very slight overweight to small caps. We did do some rebalancing in the quarter into international equities. We didn't make any changes to the manager roster in the fourth quarter, but I would note that we did make a change this week. That is, I believe now will be complete tomorrow with the final funding. We liquidated our 2 accounts with Dimensional Fund Advisors, DFA, and funded a new account, International Small Cap account with Acadian, who we also have on the international value side. And that is, we are fully liquidated from the DFA portfolios and have our final funding of the $50 million into the international small cap account with Acadian. I guess any questions about that? I'll stop and see if there's any questions about the.
Was the DFA, was that a manager issue or a
So
style
I think it boils down to a few things. There were some concerns about performance. They were definitely had been more of a style bent towards value. But I would say too, we've always favored separate accounts over commingled funds. And you know that was a factor that played into it. These were commingled funds that we were in. I would say too, and maybe put this in the category of client experience. That was a reason. I think too, maybe bottom line is just we thought we had a better opportunity. That we've had a long history with Acadian. Steve and I visited and got to meet the portfolio manager of the international small cap account last month. And so those are some of the reasons I think that the drivers of the decision to liquidate the DFA portfolios and fund this new account with Acadian.
Thank you.
And as mentioned with the domestic equities, we did the same thing with the trading ETFs on the international side, being able to put multiple brokers in competition. We made one change in our emerging markets ETFs that we found the emerging markets ETF that was significantly cheaper than the one that we had been using. It is a little bit different exposure. It'll give us a little bit more small cap exposure, but for the cost savings, I think it was 59 basis points of cost savings that it was well worth that swap, and that's been completed. So there was no other activity in the quarter. And like I mentioned, this more recent change with managers so far this year. Any other questions on international?
So with your new portfolio job and stuff, have you had any surprises?
No.
Other than how mean John is?
John's always been the same. My new job doesn't change the, so no surprise.
You.
Laughing a little too much. No surprises, but in terms of manager behavior or anything, the market's always surprised me, but
Curse of the new hire continues. We hire someone new, market goes to hell. Yeah, nothing to me, happen John.
Let me know when you're doing the next one.
If Roscoe doesn't behave, it may be soon.
I like your ethics policy. I don't know.
Oh, yeah,
Front
sorry.
running the trade in front.
Yeah, no, yeah.
All right, let's move on then.
Great. Good news, I'll be really quick today talking about STIP because tomorrow the entire fixed income team will do the STIP deep dive, which is better news, right? So I'll say the yield in STIP is finally going up, and that's also great news. Are there any questions before the deep dive tomorrow? I think so, awesome.
Boy, she's done a great job.
That's why she's the best mom.
Right, we've got the deep dive tomorrow. All right. State fund? Can you top that?
No, I cannot beat that time.
No, and don't try. Just-
If I could refer to the board to slide 45, state fund. Portfolio returned almost 3% for the year, led by strong return from equities at 23, almost 23.5%. The portfolio outperformed the benchmark by about 25 basis points over the years. The investment grade portfolio returned negatives, a little more negative than 1%. It outperformed the index by about 27 basis points. That was because of being short duration as rates went up. The difference between this and the core portfolio where we gave back some on the curve is that this is a shorter index. It doesn't have the 30-year, so we weren't whipsawed by the movements in the 30-year. About 4.4.
Okay.
And it's not quite as short as the index. We did sell about 45 million of equities during the year. That was to keep us within the policy statement and the upper bracket of the policy statement, not so much a call on equities as a whole. Any questions on the state fund portfolio? Going on to slide 47, the trust fund investment pool. The pool outperformed the benchmark by 78 basis points on the year, and that was led by real estate. Keep in mind that the benchmark, we changed it mid-year. Right now it's 6 months full benchmark, 6 months new benchmark. So we expect to be much closer to the benchmark going forward. High yield returned 8 a little better than 8% on the year. The internal portfolio returned a negative 1.3%. Did outperform the benchmark again due to short duration. Little outperformance, 24 basis points there. Any questions on the trust fund investment pool?
Just one on our managing our relationship with the various funds. I know they don't expect a lot of return, but do you have any feedback on what's happening there? I mean, is it expected from them?
So we've been messaging the decline in yield for years, Jack. We got a little break from that decline, and that decline flattened out in about 2018, I'm sorry. And so we didn't have any shock from participants. Then, of course, interest rates again fell fairly precipitously, but in knowing that, that's when we went quite heavily, fairly quickly into real estate to increase that return. So we haven't had to message to them lately that there's going to be further declines in their distributions. And so it seems like the move into real estate was the right move. And we hope to go further. We're at about 23% now. You know, we'd like to get into the upper 20s, but that will depend on the right opportunities being available.
So that's where you're trying to go, upper 20s?
Yes. And then if we get there, then we might, as John mentioned, we might come to the board with other opportunities to increase the yield.
And then this is what the administration's interested.
Yes. We have been signing up more clients in trust fund. We've added MSU, we got the healthcare benefits shop in. So, you know, as STIP, you know, again, the month that doesn't reflect the prior quarter, but now that STIP's increasing, get a little additional yield there. Trust fund rising with the real estate investments, you know, we're able to point to some real victories and get people into those higher yielding assets, particularly as we look at their cash flows.
Okay, anything else, gentlemen? All right. So we are starting at 9:30. Unless somebody else has something.
Presentation tomorrow, that's just gonna give us an overview.
Overview of DC plan and what a potential BOI involvement would look like. There's that one slide of, and that's sort of that's the place, not only for RBK, but for you to directly ask him questions. Talked with Carl briefly about timeline moving forward. But it's definitely one of those things where we're best to do it slow and right as opposed to rush in. So
what I would imagine is that would be the place to, if we need them to come back to us with more information, that would be the place where we would ask for that. And then I think what we're gonna do is at least try and save some time in April to answer any of those questions, or to see what, after tomorrow, to see what other education we might need. And then assuming that that's all doable, then in May, we would make the decision. Is that right?
That's,
I mean, that's how I got it sort of laid out in my own head. That's not a schedule that anybody has to stay with. But I think if we're gonna do it, as I understand it, you're saying July 1.
July 1 would be ideal for us from a cost perspective, because then we'll be able to bill against those assets and reduce what we bill everybody else at the beginning of a fiscal year. Also give time to John. Hopefully, we'll be able to align asset allocation conversations with manager lineup conversations for the board at the end of the calendar year, as we've been doing, so that any changes can take place at the beginning of next calendar year. So a good 6-month lead time for us to get into that.
But does that give the,
Because that's what I remember. They were saying that they had so many people they had to contact.
And that, so.
well, but does
that's-
that give their board
Yeah.
the
Yes.
time?
So that's part of what you'll hear tomorrow is that notification conversation of, we are not in the mandate.
Notification.
We're not in the notification business. We're not in the benefit administration business. We're in the investment business. So it's them delineating to us what those notice provisions are and us working back from them, as opposed to us making a decision and then pushing it upon them.
But their board needs to make the decision. Or have they already-
So I'm talking about from a manager lineup perspective. So their board needs to make a decision to, basically what we're talking about is an MOU. Who, what does that look like? How do we hand it over? What are the delegated responsibilities? Those sorts of things. Because it's authorized in statute. So us understanding in writing what their notice requirements are important for us to be able to accommodate their statutory and administrative rule requirements.
So, but my only point is that the July 1 date, we know that works best for us.
Yes.
At this point, I don't know if that works best for them.
Correct.
And all of that, we still have to take that into consideration. I don't want to create the impression here in some public meeting that we're driving the bus completely in July and it's being driven by some July 1 date. We need to be
Fair.
fair and I mean,
I
give the customer what the.
I would not be surprised if the customer wants to move more expeditiously than that. But again, this is one of those things, like, it's better to have the conversation in an open public forum, let beneficiaries participate in that process, get to the other side of it appropriately, minimize our litigation risk. And then once that, we're all comfortable, you're all comfortable that A, this is the right thing to do, and B, we have a process for doing it the right way, then make a decision. But it's $1.2 billion in assets with a lot more impacted beneficiaries than what we normally deal with.
And we talk more about this tomorrow, but if we think we can do this at lower costs to the people who are money investing, then is the decision that we make that we're willing to do that as long as there's a good, and under these divisions of responsibilities? Under
So the
certain-
decision matrix on our side
Right,
is A, can we do the work?
right.
B, can we do the work on behalf of their board in a way that is beneficial to their participants?
Right.
and see how do we do that work without harming our already high workload for our existing DB participants and
Right.
trust fund participants.
Right.
So as
Well, we get through all those questions, and my question is that then do we say, okay, we've answered all those questions in the, affirmative. We're willing to do this, and then it goes to them for their call, or?
somebody's gonna have to ask somebody to dance first.
Oh, okay.
And I would imagine they're gonna ask us to
Okay.
dance, because, the old Herb Kulo golden rule, they have the gold, so they make the rules. If they want us to take that $1.2 billion in asset, manager lineup is a DC way of saying asset allocation. So if they want us to construct that asset allocation and that manager selection process overlapped and see if there's benefits, then I think the request comes from them to us as opposed to us telling them, hey, we see you've got these things. I think the first box that needs to be checked is their board convinced that it's in their beneficiaries' best interest to come to us.
One thing I didn't notice, and I was gonna take it home and read it tonight, but it didn't talk about the fixed. There's, the component in deferred comp of the fixed. Are we talking about taking that? We're not talking about doing that internally.
The
We would,
fixed income?
yeah,
No, there's
We
not
would
enough
s-
assets there and the churn is too high for us to do that internally.
Right.
We would
and isn't that a guaranteed fund too?
very likely could be.
It is, so that's something I was worried about, that, we don't do guaranteed funds, so that would have to be.
They've got stable value, they've got the guaranteed funds,
Oh.
they've got the target date funds.
Right.
It's nothing over, really what we're looking at is a manager selection and what those options would look like from those providers to their beneficiaries, and whether or not there's a natural lineup for us to get in that space of, hey, look, you've got JP Morgan, we've got JP Morgan. Can we leverage these higher dollars to a lower fee structure?
Okay.
There's benefits of, constructing a portfolio around a white label. And so there's a lot there that I don't want to sort of precondition the board to, hey, we're going to go this way or that way. I think RVK can talk to you in depth about, this is not a unique structure. This is nothing that other states aren't already doing. So it's definitely proved more efficient elsewhere. And there's likely an opportunity for us to replicate that.
Well, we'll find out. I don't want to focus too much on process, but I also don't want us to get in trouble for appearing to, step out of our lane or be, And so anyway, that's, we'll talk tomorrow.
Okay.
All right, we're adjourned for the day. Thank you all.